където е бил там. Да. Да. Аз им беше.
Hello, hello, hello. Good morning. Hello, good morning. Good morning. So far be it from me to interrupt such nice socializing. However, every minute of that socializing cuts into the panel. And Silvia, the panel moderator, is my office mate, and she will not let me forget it for the rest of the year or the next. So let me introduce the first panel, which feels the most ESM panel of the day. We have David Sarasa Flores from BBVA and Daragh Clancy from the Central Bank of Ireland of ex-ESM fame. Discuss the macro economic implications of defense and infrastructure spending. And we have our own Silvia Calò moderating the panel. So Silvia, David, Daragh, please take it away.
Okay, just while I'm waiting for the slides, good morning, everyone, and thanks to the organizers for the invite. And I think my the 5-year penance after leaving has been served now, so thanks for having me back. Great. No. Great, thank you very much. Okay, so this is joint work with Matija, a colleague of mine at the Central Bank of Ireland. And obviously, these are our own views, especially on this delicate topic. Okay, so like I think the context is clear, but let me just quickly outline why we ended up doing this paper. Okay, so everybody knows that there's at least an intention to increase substantially the amount of defense expenditure. Okay. And obviously, this is going to have macroeconomic implications, just given the scale that we're talking about. Now, I think the first thing that drew us to this actually was the paper by Ethan when we read this earlier this year. Like, it's very obvious that defense is not a normal type of government spending, okay? And in particular, like, that paper has, you know, it's very rich. There's a million different channels you could look at. But what we're going to focus on is 4 aspects of this, okay? First, you know, what are you paying for? All right, what is the money going on? Like when you build a bridge, you can see it. You know, when you provide hospitals, equipment, something like this, you can see it. But actually with national security, the benefits are kind of hidden. It's like a form of insurance that you hope you never end up using, okay? So that's the first thing we want to capture. The second thing is, you know, and this was touched on yesterday in the panel, it's really about making it, Okay, you can buy it. You can buy military equipment, for example, but the one of the main benefits to this is the underlying technology and what you learn from making it. Okay, so there's a difference between having it and building it, and we want to capture this. The next thing is, okay, trade, and that was also touched on yesterday. You know, it's not like you're just going to the lowest bidder who can make it most efficiently and, you know, who can provide it in time. You know, you're kind of limited by alliances, for example, but also compatibility concerns. So that further restricts you. We want to capture this. And then the final part, which I've delicately put, difficulty recruiting personnel. This is not a normal labor market decision. Okay, if you're trying to convince people to join the armed forces, you know, that's not asking them to jump to a competitor in another industry. This is a fundamentally different decision. So we want to capture this as well. Okay, like I only have 20 minutes, so there's lots of great papers out there. I think basically the three things that kind of inspired us, right, is first of all, the fact that there's a lot more papers now talking about how coercion is being used to further your aims, okay? So we're going to try and get some of this in there. The next part is that, as I just mentioned, the nature of defense spending is fundamentally different, so we want to capture this. And the last part, which I don't have much time to get into today, but you'll see it in the results, you know, you have this demand-induced shift in the composition of the economy, okay? And what can that do for productivity? Okay, so I mentioned the four aspects we're going to look at. Here's exactly how we do that. Okay, so the first thing we're going to do is we're going to have all of your defense expenditure in one way or another is going to add to your capabilities, okay? And we say that the higher your capabilities, the greater the deterrence, right, from external threat, for example. And one of the things that we're going to do is link economic decision making to this level of deterrence. Okay, so it's going to have a, you know, a first order impact on consumption and investment saving or decisions. And I'll get into the details of how exactly we're going to do that. The next thing is that we're going to add a defense industry. Okay, and that's going to produce military equipment or arms. Okay, and from that, we're going to add in a channel where there's a kind of an R&D externality to capture this positive benefit of actually doing the underlying work yourself. We touched on it yesterday, but obviously, you know, when you're starting from a very low level, you know, imports are going to be an important component of this at first. Okay, so we're going to capture that you can purchase this domestically, build it domestically, or that you can purchase it via imports. We're also going to have a dual use investment good. So this is something that can be used, you know, it can, in normal times, it can be used for public infrastructure, but if the time came, it would boost your military capability. And finally, when you're trying to raise armed forces, you know, you have two possible approaches here. The first is that you can kind of try to convince people to join by offering a competitive wage. The second is this, you can just insist people join via conscription, okay? Okay, again, I mean, we're going to use the Eagle model, which has been used for lots of different issues. You know, it's kind of quite a large model, I would say. So I'm not going to be able to spend the 20 minutes that would take to go through all these features. I just highlight the main ones. Okay, first, we're using a 4-block model. So there's 2 in the euro area, Germany and the rest of the euro area. Now, in my results today, I'm just going to focus on just the euro area. So it's just going to be an aggregate of these two, and I'm not going to assume any differences in policy or anything, okay? Then you have the United States and you have the rest of the world. On the household level, you're going to have, you know, the usual frictions that we have there. There's going to be Ricardian and liquidity constraint. It's not going to play any role, or well, it does play a role, but I'm not going to emphasize these aspects later, but you can think of lots of ways that you could. On the firm side, you know, there's lots of different sectors. So there's a tradable, non-tradable, a re-export sector. And now we're going to add a defense sector, and there's going to be sticky prices in that. And then in terms of policy authorities, obviously we're going to have a central bank. So Germany and the rest of the euro area share a central bank. The others have their own. And given what the conference is, I apologize. So what we're going to do on the fiscal side is just, we're going to allow this increased expenditure to all be debt financed. But then when it has to be paid off, we're just going to let it be lump sum taxes, okay? Because it's the least distortionary. Now, the first element of what we're trying to achieve here is to build a framework to think carefully about how defense expenditure might impact the economy. I think that this is obviously one aspect that we'll come back to, but just for now, we're just going to let this work in the background. And in these different areas of the international economy, there's trade in goods, and obviously there's an international bond market as well to intermediate savings. Okay, so this is the first part I wanted to talk about. So as I said, your defensive capabilities, the greater they are, the greater the deterrence that you have, okay? And it's going to be a function of three things. So the first is this term on the left, this 𝘂𝘶𝘺. This is just dual use investment. So think of this as something like sonar technology, okay? It could help you detect if drones are coming into your airspace, but it could also be used for search and rescue, okay? Or any other civilian purpose. That's going to be produced by government investment, and it's going to be free to all firms in the economy to use, okay? So just think of it like infrastructure. Now, the second one is getting more into the details. It's military equipment, okay? So think of this like arms and defense systems. It could be planes, tanks, anything like this. And the final one is military personnel. Now, the way we model this, you're going to need both. There's no point having loads of equipment and nobody to use it. There's no point having a huge army and not, sending them out with sticks. So another important element of what we're going to do here is, this isn't a frictionless market, okay? So what we know from the data is that there's long delivery times here. So we're going to incorporate this in. And in particular, what we're going to say, I'll come to the calibration later, but just in case I run out of time, I'm going to say it takes 3 years to deliver. And in this market, you pay up front, and then you receive the delivery sometime later. That's what we're going to assume. Now, something that I want to highlight at this early stage, because it's going to kind of preempt some of the results, this expenditure on the E and N, it's for a kind of potential service. As I said before, you're building this capability hoping you never need it, okay? So because of that, in national accounting terms, it's a kind of a strange beast, right? What happens is the government value added gets high, but there's no, once that capital and labor is allocated to these sectors, you can't really use it for anything else. It just kind of sits there as an insurance policy. Okay, so, and how it's going to enter the national accounts is through the wage bill and the depreciation of equipment. That's the kind of two features here, but I'll come back to this. Okay, as I mentioned, when this all started coming more to the fore, when we started looking at our models in the Eurosystem and what we do, it was clear that obviously none of us had ever thought about the role that security should play in economic decision making, or at least I hadn't done it. So what we're going to try to do is put a direct link in here, and what we're going to have is kind of two kind of guiding principles, right? So first, there's going to be an inbuilt asymmetry here. You can have enough deterrence, but any more than that is just wasteful, right? So you're going to be satiated at a certain point. Now, as I said, it's asymmetric. So anything less than that, you're not going to be happy with, and I'll show you how. But, close enough to satiation, it's fine. You're not really that bothered. But once you start to move further and further away from the required level, it's going to start impacting you more and more and more. So how we were kind of inspired by this is when we were introducing macroprudential rules in Ireland, we had the capital regulation, the ratio that you needed to achieve. And how banks kind of behaved was that, as they were far away from the ratio, they didn't care. But as they came closer and closer, they would really start doing everything they could to meet the ratio. So this is kind of what we have in mind. Now we're going to put in a function that I'll show you in a minute that kind of gets this. But overall, how we think about national security in this model is like it's a public good. So if you have a sufficient level of national security, it kind of facilitates smooth functioning in the economy. That's kind of simple as that. Now, so I'll just go straight to investment. Okay, so what we're going to do is we're going to take just a standard capital accumulation equation. We're just going to add this one term at the end, okay? And the functions below there, you'll see. Now, in the steady state, this is going to be a value of 1, which means security concerns, deterrence, none of this matters whatsoever, right? You're making investment decisions based on all the standard things that you make decisions, you know, your marginal product of capital, expected demand in the economy. But if your deterrence falls by a certain amount, now you're going to start weighing it more and more. So it's going to come from a value of 1 down, okay? And we think of this as like the risk that some of your capital might be damaged or destroyed, for example. So you only get a certain amount of it. And that's going to have 2 effects. The first is, well, simultaneously, the first is your existing capital stock, which is the first part of the equation on the, and the second part is your forward looking. So you're going to be concerned about the investment you've already made, but you're also going to be you're also going to be concerned about the investment you haven't even made yet. Okay. Now, the important part here is before I showed you D, which is your own contribution to your deterrence. But here we use D tilde. Why? So in Europe, we're going to make an assumption, and that is that the value of your deterrence is a function of what the US provide and what Europe provides. So for Germany, that's what they're producing and contributing, plus the rest of your area, plus the US. Okay, so it's going to be kind of a joint deterrence. This is just an illustration, so let's not get too caught up in the precise slope here of this curve, but I just kind of want to show you what this function does. So let's say in steady state, you're at point A. So your probability that your capital is safe is basically 1, I think it's 0.9999 or something. You know. Now, let's say something happens. Either the US says, actually, we're not going to provide as much deterrence to you, or for some reason you let the size of your military equipment decrease. What you're going to do is you're going to move back down the curve, okay? And your behavior is going to change, obviously, more and more the further down the curve you are. So if you just kind of move in the region of point A, you're not going to really see any effect. But as your deterrence falls by more and more, it'll have a bigger impact on investment decisions. We do exactly the same for consumption. We do exactly the same for consumption, where basically now we're going to have public security or national security be a complement to private consumption, okay? So think of this like, you know, just your fear of being out and doing normal activity, okay? So again, this is going to be a function of, you know, what's going on in the US and Europe. And it's going to, the curve is going to work exactly the same way in this. How am I doing time-wise? I can't, this is, I need to speed up. Okay. Okay. I wanted to spend the most time on that and was, you know, taking my time because that's really the new stuff. Okay. All the rest is kind of standard stuff with a term thrown in here and there. Okay. So in terms of the defense industry, the 2 things is this KG, which is classic public infrastructure, so I'm not going to spend any time on that, and this ZD, which is going to be your R&D, you know, that you get from making it. And really the main thing to know here is that you reduce your marginal costs. Okay, so again, I can feel comfortable skipping this relatively quickly. 2 things I want to say about R&D spillovers, because it came up yesterday quite a lot, and it's something that's quite crucial to all of this. First, your ability to generate this knowledge is a function of how much you're doing. So that's this zeta term here. So the more you're producing, the more you're capable of learning. Okay, that's the first thing. The second thing is this term below this A. What that's going to show is how fast that knowledge transmits to the economy. Because again, it's not quite clear. You know, sometimes the military might want to hold it back from going out. Sometimes it might go faster. But these are 2 key parameters. Now, again, I can skip past this. Sorry now that I appear to be rushing, but I think that the first part was the crucial part you had to understand. This is just telling you that I can buy military equipment at home or abroad, and it's going to be a function of relative prices and preferences. Simple. I already explained this. Your military is a function of professional recruits and conscripts, and we're going to add all sorts of things that I, you know, don't have time to get into today, but like a wage premium. For conscripts, you can pay them essentially whatever you want. It's up to you. Now I'm going to turn that off today, just because that's another layer of complexity, but it's there in the framework. Calibration is tricky. So we saw the discussion yesterday about the level of imports. Okay. One thing that the data has is everything is in quantity based. All the trade flows are in quantity based, and that's quite confusing, you know, for at least for me, and we were trying to think of how this should look in an economic model. So what we spent quite a bit of time was converting this to value-based. So the Stockholm International Peace Research Institute did this for 2020, and we made a time series going back from 2001 to 2020. Obviously, you know, these parameters are going to be crucial, especially the R&D spillovers, how fast it comes or whatever. What we've done now, okay, so there is some empirical evidence, mostly for the US. What we've done for now is calibrated it to be enough to have an effect, but not enough to dominate everything, okay? So like I don't have time to get into this now. Okay. Have I recovered some bit? Okay. No, I'm still in trouble. Okay. Right. So here's what we're going to do. The first simulation I'm going to show you that this bites is the US in normal times. I'll just show you this graph actually. So I calculate this. So I'm making an assumption here, which is the amount that you've spent over the last 20 years kind of shows a revealed preference of how much you think you need to spend to have an effective deterrent. So if I just add up US military spending plus Germany plus the rest of the euro area, and then I divide them by their shares, I get that the US provides between 70 and 80% of European deterrence, and Europe provides the rest, okay? And then if I calculate what it would be if everybody spends 5% of GDP like NATO are saying, I get to about 60-40 split. So the first shock is just going to be this black line. That's it. The second shock is just going to be this blue line. All right. Okay. Now, first, just top left is the actual shock itself. So now the US has just basically said they still have their own capabilities, but the amount that they're willing to share with us has fallen, which obviously decreases in the bottom right our own defensive capability. Now, of course, because I've set up the model this way, so I'm not claiming this is, you know, this is just a proof of concept here. Investment and consumption both fall, output falls in all sectors, and labor has to increase because now you've had an income hit, so you have to work more hours. Okay, this channel shouldn't be surprising because, you know, it comes directly from the equations I showed you earlier. Now, this is where we start to get into the novelties a bit. Okay, so again, as I said, you can have some of the equipment, you know, so in this, I think it's a 1 percentage point of GDP roughly increase in the amount of military equipment that you're buying. So some will come from domestic, some will come from imports. Key thing I want to show you here is that, first of all, the R&D stock, it takes time to build up. So it takes time for you to learn about this, but eventually it becomes a useful feature. Same with your equipment. Now this build up there is because of delays. You're going to have to work more because now just more production needs to take place in the economy. You've had this kind of big fiscal stimulus. There's no migration in this model. There's no structural unemployment. So just you have your fixed set of resources. And what we see here is output goes up substantially, but this is what I was telling you earlier. This is all government value added for the most part. Output in the other sectors gets crowded out, okay? Because now you have this defense industry that needs to ramp up quickly, and they're taking the capital and labor for the most part. Consumption gets crowded out, of course, because you're trying to save to make this big investment. The wages one is because R&D now boosts your productivity. Okay, so you're able to be paid more in this example. And obviously, given my role, this difference between CPI inflation and GDP deflator is massive for me. Okay, because CPI doesn't contain any of the military expenditure. It's just excluded from it. And now you've had a real effective exchange rate appreciation because European output goes up and rest of the world and US, nothing's happening. So the cost of your imports goes down, so CPI inflation goes down. But GDP deflator, which is kind of the overall cost level of the economy, is going up. Now you're going to have a very similar thing for military personnel, but I'm afraid Sylvia will never talk to me again. So for now, all I wanted to say was two things. One, security risks can have a real macroeconomic effect in and of themselves if people actually believe this. And two, if you want to deal with this problem, it's going to imply a massive compositional shift in the European economy. And we need to think carefully about what does output actually mean and what's the crowding out effects on other economies. Sorry, Sylvia.
Thank you. Thank you very much, Daragh. Now, David.
Okay. Let's see if I have my slides. Okay. Okay, perfect. So sure. So thanks to the ESM and SUERF for this fantastic conference. And I'm going to present a project that is now a working paper that we've been working the last months, which is about addressing and revisiting this, all what we already know, this dilemma of guns and or butter in Europe. Okay, so this project started with the news and announcement surrounding the readiness and rearms 2030 plan. Okay. We in Europe we're gonna experience or we expect to experience an unprecedented fiscal impulse sourcing from the defense sector. And the plan in this project was to, okay, let's introduce this into our forecast, into our macroeconomic scenario. And to do so, we need what we call the elasticity, which is the fiscal multiplier of the defense, this such a defense spending in Europe, which is going to be composed by 150 billions used by the SAFE instrument, and the rest fiscal space created about 650 billion euros in Europe. So the motivation was pretty simple. We are going to experience an unprecedented fiscal impulse in Europe. We have to, and we want to introduce it in our forecast, but then we need the elasticity. But looking at the literature on the topic about fiscal multipliers and the usage of military spending as a source of exogenous variation of defense spending, we found no evidence of this at the EU 27 level. So that's what we do in this paper, is to estimate the elasticity of defense spending in Europe, the fiscal multiplier, looking at the history that we have for Europe, which is in many cases more limited than for the US, looking at accrual-based data from Eurostat, which from our knowledge better aligns with national accounts and GDP figures, so that it could be better gauge and assess the impact of defense spending on economic activity. Okay, in this case, we use a set of linear and nonlinear local projection methods to estimate first the linear fiscal multiplier, and then explore if there are sources and potential sources of nonlinearities that explain differences in the size of the fiscal multiplier. First, we try to address several questions that are now in the current debate in Europe. Some of them were mentioned yesterday, for example, by Angela and Ricardo. They mentioned about the importance and relevance of the composition of spending. It's not the same spending on guns, spending on tanks, aircrafts, than wages, for instance, or intermittent consumption related with such spending. So that's what we address as well. First, we address and we estimate the linear defense and cumulative and dynamic fiscal multiplier. Then we focus on if what the money is spent on matters or not, distinguishing between the components that we will see thereafter. Then we try to answer the main question of the paper, which is, okay, historically, as Ethan mentioned yesterday, we haven't seen a substitution effect when defense spending increases. What happens with the rest of the spending, what we call as roses, which is called butter in the literature. And we try to answer if defense fiscal multipliers are per se higher than non-defense fiscal multipliers, and if they are more persistent or not. And the persistence, spoiler, will be related with the composition of such spending. And then we explore if there are potential sources of nonlinearities of the size of the multiplier and its persistence as well. Okay, we focus on fiscal space, which we all mentioned yesterday, and the way the European Union relies on military imports from the outset, so that the military imports dependence would be a state variable that will explain if we convert to states of high import reliance or low import reliance, the way the multiplier changes. And finally, we derive from this set of results a set of policy implications that, from our knowledge, from our perspective, could be useful from the implementation and development of the strategy as regards to defense spending in Europe. We don't have time, as Daragh said before, but we focus and three strands of literature. The first one is to use and isolate exogenous fiscal shocks to see the impact on economic activity, and especially on the use of military spending. Use 𝘮𝘯𝘂 for the case of the US, but we use a different strategy, as we'll see now. Then we focus on a second strand of literature that is estimating fiscal spending multipliers in cross-national panels, because we estimated that for the panel of the EU 27 countries. And then we focus on a third one that is exploiting and assessing if there are sources of nonlinearities in fiscal policy transmission. So that we end up with, and we work with an annual panel of all the EU 27 countries from 1995 to 2023, data spent for which we have Eurostat defense spending and decomposition by the ESA 2010 data available. And that's the data we use. So first thing we estimate this linear and dynamic fiscal multiplier. As you see in equation 1, what we are interested in is an estimated the beta 8, which is the fiscal multiplier of cumulative defense spending, which is D subscript C. C indicates that the variable is cumulated from 8 equal to 0 to 8 in this case. And we see the impact, which is a directly formed on estimated the cumulative fiscal multiplier on output real GDP in cumulative terms, both because they have to be the same units relative to a trend GDP in this case, which is extracted from estimating a quartic polynomial on T of real GDP. Then we introduce different controls, and we also try to see if it has a persistent impact on economic activity by using the variable Y as annual real GDP growth rate. Going briefly because I will not have much time. What we find is in the left panel, you see the impact in output terms, normalized by trend output. And we see that we experience in Europe a multiplier above unity, which peaks 2 years after the shock, but then converges to 0. But then when we see the impact on real GDP growth rate, which is on the right panel, you see that the impact is not persistent. It comes back to 0. And that gives hints on the composition of spending, as I will talk now. Then, common assumption in literature is to use military spending to instrument total government spending, arguing that defense spending, military spending, only responds to geopolitical or national security events. Okay, but what if not? So we conduct two types of tests. The first one is in the context of local projections, a Darwin-Hausmann test, and we find that it is exogenous to economic activity in our sample and in our type of data. And then we conduct the second one, that is an instrumental variable approach, where we use the geopolitical risk index as an instrument for defense spending to isolate the variability in defense spending that is explained by geopolitical risk in this case, which is the argument that is used in the literature to use it as an instrument. Then in this case, I don't spend too much time here, but we don't have the geopolitical risk index for all countries in Europe. We have it for 13, 14 countries. We extend it to the rest of your countries by using a spatial model when we have different linkages through which and different transmission channels through which geopolitical risk transmits to other countries and neighboring countries and trading partners. Okay, we use distance, a matrix of distance and bilateral spread. We find in both cases, the first case, sorry, we find that it is exogenous. In the second one, we find that the multipliers are similar. The instrument is relevant, but not very strong. Okay, but we first found that it is exogenous. What about the composition of spending? Something we talked yesterday about. As you see here, historically, this is the aggregate for the EU 27. Defense spending has been composed mainly by 3 categories: by GFCF capital, this is the blue bars; personnel, which is 99% wages, which is the red bars; and the green ones that are intermediate consumption. What is inside this term, in this component? We have a maintaining cost, we have sometimes ammunition, which is not very clear sometimes, but 99% of you see an increase in transfers last year because of some countries transferring capital to Ukraine, for instance. Okay, but we focus on those 3 categories as they are the most, and is quite clear, the most representative of the aggregate defense spending in Europe. What about R&D? Daragh told about R&D. We yesterday talked about it. In Europe, the figure about R&D is devastating, is declining. And last data point that we got, this 2023, is about 1.8 spending on R&D out of total defense spending. And it has been a declining trend. What we do, we look at the data of the country-specific and year-specific data. We find that for so many countries, there are data points that are zero, so that we don't use that measure because it's quite low as regards to the total defense spending. And we estimate similar regressions as equation 1, as the one before, but using as a shock the different components of defense spending, and at the same time controlling for the potential complementarity effects between types of spending or substitution effects between types of spending. Okay, the purchase of tanks, for instance, could have an effect on an increase in personnel wages or an increase in maintaining cost of the tank, so that we control for that as well. And we find that the aggregate total defense spending multiplier is explained in this case by left panel A by GFCF. We find it multiplies about 2 in this case, 2 years after the shock. And of the other components of defense spending, we find a slightly not very significant impulse on personnel, which is explained by an initial and transitory impact on consumption. And then we find no significant impact of intermediate consumption. But when we try to answer that question of guns or roses, alluding to the main title of the paper, if we look at columns 7 and 8, we focus on what is the impact of capital spending of defense against non-defense capital spending. And we find that in the short term, as you see the previous slide, capital defense spending is very significant, is high, but then it's transitory. It returns to not being significant. But what happens with non-defense is the contrary. It's low at the beginning, but it's persistent. So that we have a statistical difference 2-3 years after the shock that then vanishes because non-defense spending is persistent, contrary to defense spending. But then we are very interested, and is now in the topic, and is very now in the literature on fiscal spending shocks, which is trying to gauge some nonlinearities of the multipliers. First, we focus on the output distribution, how the business cycle can shape the size of the multipliers. So that what we're doing here is to estimate how these shocks can affect the whole distribution of output by estimating quantile local projections. So we are interested in this beta H, that is now beta H tau, which is the quantile of the output distribution. We focus here on 20 quantiles of the output distribution from 0.05 to 0.95, so that we have 6 different horizons multiplied by 20 different quantiles, so that we end up with 120 estimated coefficients, which we can end up in a very illustrative way. We can end up mapping and obtaining what is the surface, which is a 3D plot. What we have on the vertical axis, this is the Z axis. We have the size of the multiplier. Note that in the surface, the darker the color, the higher the multiplier. And then we got on the right-hand side, we can have this x-axis, as we call it, and then the y-axis. Note that the x-axis, which is the quantile, is reverted, is opposite, so that as we move to the right of the x-axis, we move into times of recessions of the trended output very low as compared to the historical distribution, and the other case, on the contrary, when we move to the left of the axis. And in line with some literature, although there's a big debate in here on how expansions or recessions shape the size of the multiplier and persistence, what we do find in here is in line with some evidence from Auerbach and Gronditsenko from 2012. We find that in times of moving to the right part of the x-axis, when we move up to times of recessions, the multiplier is substantially high than as compared with expenses. Okay. In both cases, we find that all multipliers are transitory as they converge to 0. Okay. But we can conduct cross-sectional cuts of this surface so that we can see the statistical significance of the multipliers across horizons and quantiles. So in this case, you see the peak, where the size multiplier peaks, which are from year 1 to 3 after the shock. We see that multipliers are in a declining trend in both cases, but as we move to the upper tail of the output distribution in terms of expansions, the multiplier is not very significant. It's much more significant in terms of recessions. And then we explore two additional sources of non-linearities. In this case, fiscal space measured by the snowball effect. We take into consideration the debt stock, the lagged debt stock in T-1, but we also consider, which is very important, the sustainability term of debt of fiscal policy, explained by the R minus G differential, the interest rate growth differential. We conduct robustness checks and check that that differential is important as regards to explaining this potential state dependence. And then a second one that is, as I explained before, the reliance of military imports from the outset. How Europe depends on imports from mainly, and not mainly, there's a debate here. The figures say that not so much from the US. Using Comtrade data, we construct a measure that is total military imports relative to total defense spending. Then we refine this measure as well as with using robustness checks, using instead of total defense spending that could be potentially importable. For instance, more capital spending instead of wages in this case, no? And we find similar results. So that we estimate these smooth transition projections when we have, in this case, two states of the economy. In this case, multipliers, which is beta superscript AH in terms of when the economy converges to a specific state, and the contrary, when they converge to a state B. In this case, state A, in this case, explains times of compressed fiscal space, as many countries in Europe now face now. And then the second one, beta A, in this case, explains times of heavy reliance of military imports as regards to total defense spend. The first case, fiscal space. And you see in this plot, the blue bars indicate the fiscal multipliers, the dynamic and cumulative fiscal multipliers in terms of expanding fiscal space, and the red ones in terms of a high snowball effect and a compressed fiscal space. And we will find that systematically, the multiplier, the cumulative and dynamic multiplier is higher in terms of expanded fiscal space through many too many mechanisms could be behind this effect. For instance, risk premium effects and sovereign markets, for instance. But we don't get too much into the potential mechanisms driving this effect. We present evidence on the difference, and then we focus on the second potential source of nonlinearity, that is the military imports dependence. Our a prior is simple. The way, and if a country relies more on import dependence, the lower the multiplier, as not all defense spending is produced home or inside the EU. Okay, and we do find that in times of high import dependence, red bars, 5-6 years after the shock, after the defense spending shock, the multiplier even converges to negative or close to zero. On the contrary case, when the import dependence is low, is substantially low, the multipliers are substantially higher. And then we conduct this following exercise. That is, what if we combine those two worst case scenarios? That is, if we experience in our panel a low fiscal space scenario and a very high import dependence scenario. That is something that in some countries in Europe is happening indeed. Okay. What we define is, and you can see here that those red bars, the bars on the right, we find that the multipliers are not statistically different from zero at any horizon in this case. Okay, so that could sign a little bit of what's going on with if we move as countries in Europe to the worst case scenario. Finally, and I end up 1 minute, Sylvia. We conduct additional tests as well. We also, and I want to show one of them, we focus on what if we use a different measure of economic activity, that is unemployment. What are the effects of defense spending on the labor markets related with what Daragh explained before? We will define a significant impact on unemployment rate, a decrease in unemployment rate, which is aligned with that effect on economic activity measured by normalized GDP. And then on the right-hand side, we also see that that effect is nonlinear as well, and it's significantly nonlinear. But I don't show the graphs in here. But we see that in times of, and again, the x-axis is inverted. In times of low unemployment rate, the effect is lower. Otherwise, in times of high unemployment rate, the effect is substantially higher and produces an even higher reduction on unemployment. Finally, from these results, we can derive some and several policy implications. The first one is, in this case, and in the absence of R&D spending in Europe, what we see is that capital-intensive procurement has a higher impact. So that focus spending on that type of spending will be more relevant and fruitful for Europe. Then the absence of R&D spending gives signs about the persistent or not of the multipliers. And then time stimulus and fiscal shocks and stimulus to periods of economic slack, as we've seen that in periods of recessions, the size of the multiplier is significantly higher and substantially higher than in times of expansions. Then, as we've seen, fiscal space is relevant, so that preserving fiscal as something that we all say at every time, fiscal credibility and space will be essential to impose the size of the multipliers. Then also enhance and related with import dependence reliance, enhance domestic supply chain so that Europe depends less on the outside, also from US. And then finally, this is a general policy implication that is to maximize spending effectiveness. We are, as economists, we are not very expert on the field per se of the defense industry and sector, but if economists take a role on this, we can maximize what is the spending effectiveness and economic impact of the strategy of defense spending in Europe. So that's all, and thanks for your attention.
Thank you very much to the presenters, to Daragh and David, for the very interesting papers that definitely push our knowledge a bit further on a topic that Europe had hoped for a while it could forget. You showed us how to do things, but you came to a policy institution whose job is to find a cloud in a clear sky. So my question will be, while you were working on this, what did you see something and you thought, this is the risk, this is where things could really get wrong? So sorry for the pessimistic question, but this is how we get prepared. And then questions from the audience.
Perfect, thanks. Well, I did work here for almost 7 years, so I do tend to look for the cloud as well. No, for me, it's this point I mentioned at the beginning about what is output. You know, we're like what our model shows is that like you have a lot of activity, but if the end result is for something that's not is used for one specific purpose and essentially parked, you know, so what does that mean now that you're putting so many resources towards this? So I think that's probably what I see as the risk, is now you just have, you know, I want to be very careful with my words here. It's something that you hope you never have to use, but then by not using it, it kind of, you know, it's detracting resources from the rest of the economy. So I suppose crowding out would be the short way of answering that. Sorry.
Yeah, but the risk, for instance, and translating those estimated results to policy. For instance, we have here that in Belgium, for instance, they have increased defense spending based on an increase in pensions for the military personnel. So that in this project, what we find is that, as I said, that it matters what do you spend the money on, so that spending on different things than pensions or wages could have a bigger impact on economic activity. But my second point is that the absence of R&D spending as well is indeed a risk for Europe, in the sense that if we don't increase that share of R&D spending, the potential persistent impact that we could have if that spending is based on technology and the spillovers that you can generate across sectors in the economy and to the civil sector, we can minimize that effect, that persistent effect, if the plan and the strategy is not focused on that type of spending. So that those two messages that land in those results.
Thank you very much. So I'll start taking questions. So Ernest, then Lucio, Giovanni, and Martin. Actually, Giovanni last, since he's from the house. And thank you.
Thank you very much for these two excellent presentations and papers. Much appreciated. Now, we also heard about this theme a little bit yesterday. And what I'm still a little bit struggling with is two opposing, effects. The one is crowding out, just mentioned by you, and the other one is positive spillovers. And these two effects can apply both to the labor market. Yesterday, for instance, we heard, wow, defense spending, defense industry creates such excellent, high quality workspaces. But again, you can have crowding out. These people could work in other fields except for in weapon production. So how do you assess the balance between positive spillover effects and crowding out effects, both in capital and in labor markets? Thank you.
Many thanks. On the first model, two questions actually. One is about the concept of deterrence. Namely, I wonder whether your conceptualization takes into account what in IR theory is called the security dilemma. In other words, a sufficient level of defense is essentially is not an objective quantity, is a function of the intention of your enemy.
All right.
So that's why we have arms race. So I wouldn't know how to model it, but I gather that since here you just model the West, this is not taken into account in your model. The second point is about the result of the model of growth, and perhaps you can help me understand the effect of growth in the following term. So what happens to the accumulation of productive capital, which I would understand, but please correct if I'm wrong, occurs in the private sector? And linked to that, the effect on R&D. And let me illustrate what I want to say. I recall a conversation with an Israeli economist, a friend of mine, about, and Israel is often quoted, as a model of an economy that benefits a lot of the spillover. He told me, make no mistake, if Israel could devote the same amount of R&D expenditure, military orientated, to civilian expenditure, if my son, who works in an elite unit of the Israeli army, and here I get back, could work instead of in a Silicon Valley firm, Israel would be much richer. So when one discusses this spillover, again, does one take it, or implicitly, going back to the question I had last year, he assumes, yes, we will cut unproductive social expenditure, and we will boost R&D. Military R&D is not so good, but in terms of, there are still some spillovers that are lacking from invalidity benefits.
Thank you for really great presentations. My question is to David. It goes a bit into the direction of the previous interventions. When you showed the underlying data, the variation that you're using in your estimation is one that essentially exploit mostly reductions in defense spending. Now, of course, in your setup, you assume a symmetry, but I wonder whether this does not play really a role also in reading and interpreting your results. I was very much surprised by the finding according to which non-defense spending, if it is investment, has a persistent effect, while it has not a persistent effect when it's defense spending, so investment spending in defense. And in fact, the period that you exploit in the data is one where we substituted, loosely speaking, essentially the protection from the US with our own defense spending. So maybe there is a sort of an effect that we essentially reduced defense spending, investment spending, and then used it for something else. So in a way, I'm not sure whether you can assume really as a symmetry in your setup, and whether you have thought about this. Thanks.
And there was one last question there. And then Ramon and Giovanni last.
Thank you very much for the presentation. I was thinking about the theme of this conference, geopolitical disruptions and debt sustainability. And my impression is that we do focus on the first part and that we kind of lose the vision when it comes to discussing the second part. So yesterday, the panel unanimously agreed to the idea, how do we fund all the additional spending? Well, we just issue more debt. And today we again heard the expression that we casually assume that we just sell more bonds in order to fund all of this. And this is in an environment where we, yesterday we had these charts, and maybe we will see some more charts today, in an environment where we have debt to GDP ratios way above targets and increasing, where we have fiscal deficits way above target and increasing, where there's rarely a month in the last year or 1.5 years where there is not a downgrade of a European sovereign. So debt sustainability really is an issue. And yesterday we talked about yields. And to me, I question myself, is there any thought of who is going to buy all this additional paper in the market? And what does it mean for the refinancing cost of Europe? And isn't there the danger that sooner or later we will have some sort of a disruption when it comes to some sort of a buyer strike? Because all the investors see the very same graphs. All the investors will sooner or later ask for a premium. So is there the danger that we lose a little bit the side of debt sustainability when we focus about multipliers to the GDP of spending, where we don't have the money to spend it, that we have to borrow the money?
So now then take Ramon and Giovanni's questions.
Yeah,
So
okay.
then you don't mind.
Okay. So on Ernst's question, on the crowding out, like there are spillovers and the spillovers are important. So there is a benefit. I suppose it just comes down to the fact that the upside of where you're sending all your capital and labor is limited because there's an asymmetry. Once you have enough, there's no benefit to any further. Okay, so that's why the crowding out occurs. So you do get these spillovers, but once you reach a certain point, whereas if you were boosting production in the tradable or non-tradable sector, it can impact a lot more things. So that's, I think, why we see it. Lucio, the arms race, yeah, we model the Western side intentionally, but I mean, it's all you have to do is flip it, where the rest of the world increases their defensive capabilities, and you get into this. But for now, I think the situation we're trying to model is what we're faced with right now, which is where the US is saying, well, you know, our contribution might be lower. On the capital accumulation, it is households. I didn't get the second, sorry, I didn't have my notes, but I can catch up to you afterwards. On the debt sustainability point, absolutely. So there's two parts of our analysis. The first is to think very carefully about something that is not in macro models for the most part. So we want to get these transmission down. This is our first external presentation. Then what you're talking about is all the conjunctural, right? So now we carefully put it into a high debt state. We put it in where fiscal risks are there. So I think what we've shown now is the machinery. And then later this will come, but absolutely. Just to answer your point on who will buy the bonds, at the moment, all the consumption is crowded out. because they're saving and they're just saving via bonds. But totally accept your point.
Yep. And asking to the direct question by Martin, well, two things. The first question about to what extent the sample and the first decline in defense spending and the subsequent increase after 2016 about the Crimea conflicts, how they can shape or not the size of the multipliers. There's a fundamental issue because we have explored that as well, but we have split basically the sample between times of decreasing defense spending and times of increasing defense spending, where we don't find significantly different results between both, so that we cannot extract conclusive things about this analysis. And the second one that is very fundamental and interesting about the persistence of non-defense capital spending as compared to defense capital spending. Maybe, and we have to look at it because it's something very interesting, is to see the share of R&D or technology on the other side of spending outside defense. So how much of technology and R&D are inside non-defense spending, and how this can shape the persistence of the multiplier as compared to the defense capital spending.
Thank you. So, floor to Ramon.
Yeah, thanks. It was very interesting. Just this question that goes back almost to the first question you had. You're talking about public goods and externalities, and also then you talk about coordination. It seems to me a little weak, because the question is, what you really will say that this is certainly an European public good, and in particular, how it's not just the level of expenditure of defense, but in particular things, like not depending on Musk for the satellites in Ukraine.
Thank you. Now we pass the microphone to Giovanni.
It'll be very fast, Silvia.
We have one afterwards, one from Robert.
No, my question, thank you, both extremely interesting and thought-provoking. But the thing that came to my mind while listening to you is, what is the baseline? And there is one thing that finally I figured out, is that the big difference between Europe and part of Europe, particularly in the US, is that the US can increase defense spending, but war is highly unlikely that will come to their land. Whereas for Europe, this is not exactly the case, in the sense that, and the risk, and a little bit, this is also what Lucio was saying, the risk that the war might come into our territory if deterrence is not strong enough is concrete. Okay, so this raises really the question, what is the baseline? I mean, what is the scenario that we have to think about if we do not have defense in the picture, if that deterrence is not there? I mean, and the baseline needs to change a lot depending on whether we take the Baltic countries, countries that are more closer to Russia more in general, or countries like Ireland or Spain that are far away. And by the way, this we see also in the perception of people, because in Spain, in Italy, also in Ireland, I guess the perception of the urgency of this need is much weaker than elsewhere. Thank you.
Well, thanks a lot for these very interesting papers and discussions. I wondered about David on this aspect. If you estimate fiscal multipliers, it's basically a government expenditure shock in a way for 1 year, and then it fades out over the coming years. So according also to the first presentation, this military spending will not be a one-time shock, but it will be persistent over the next 5 to 10 years. And if, given that it's a long time scale, you have to maintain the military equipment. So I think it's a bit of it's an interesting analysis, but it lacks a bit this time dimension that this military spending will be in here for many years now. And this is, I think, for the interpretation of the results should be taken into account.
Great, thanks for the comments. So Ramon, on the coordination, I mean, yeah, so at the moment, you're in control. So you're in control of your own national deterrence, right? That's what your spending influences. Then the others are kind of exogenous to you, you know, so it's true. But if you notice that theirs have gone down, you have a choice then on what to do. On your point on Musk and stuff, like, again, the framework we're trying to build can incorporate that. You can just make some goods irreplaceable from any other source. So we can play with something like that. One of the things, I didn't have time to get into it, but I just put capital and labor as equally important, but you could put, you know, for different countries, and somebody mentioned, Giovanni, like some countries that are, you know, face different types of risks might be more capital intensive than labor intensive, you know, for things like this. So it's a fair point though. Giovanni, on the baseline, my answer is, like I said before, like we kind of stop. This is all preemptive, right? We don't, in our model, you know, you never need it. And I agree with you that this is a fundamental point, like, but we don't go to the actual state where there is a war. It's just like, if you notice that your capabilities are lower than they should be, what do you do? And what do you do about it? But indeed, yeah, I think it's super important, the end point.
Yeah, complementing with Daragh said about your point, Giovanni. In the social point in this case, and the social view of the emergency of the threat from Russia, from southern countries in Europe, and from a case in Spain, the country I'm from, this also, and it's just starting to change a little bit of emergence from also the south, so that Europe is threatened by the eastern flank from Russia, and then also the south from North Africa as well. So that's kind of changing a little bit on the social view on that, so that could hurry up a little bit that sense of emergence of building up defense capabilities across the entire Europe, not only the eastern flank, but also what was the baseline, right? But the baseline is about increasing the deterrence capabilities of Europe, and it is not only about increasing the defense capabilities of Spain or France or Italy. It's about having the possibility to help in the sense with military capabilities the rest of countries that are current in the conflict. Okay, and answering to the very interesting point by Robert, that indeed is one of the main things of multi-annual defense programs. Historically in Europe and in US as well, the programs are designed by 5, 6, 7 years. So that's a very interesting feature to include in this analysis. That's why we focus on this cumulative version of the shock, so that we take into consideration what is the shock in T, what is the defense shock in T, but also this cumulative across time, so that in 2 years after the shock, you see economic activity impacted by shock in T, T+1, and T+2. So that you take into consideration this cumulative nature of defense spending when estimated those fiscal multipliers.
So thank you very much. It was a very interesting session, but kept us all awake in the morning, and we're ready for our coffee. Thanks to the audience for the very nice engagement, the excellent questions, and we'll see you outside.
Thank you.
Thank you.
Thank you.
Yeah, I know. I was keeping everybody on time.
Good.
Then
Oh, actually, we were good.
No, no.
Well.
I'm very strict.
Yeah. Yeah, but I thought at the beginning you were going to add something, but you don't really started with the presentation.
Yeah.
It was efficient.
Yeah, no.
Yeah, we should.
I just totally forgot to bring a pen.
Yeah, we.
No, but normally I
Yeah.
always.
So do I, and today, instead of taking my notes and my block and pen, I picked up my earphones for some reason by accident from the desk. Yeah.
No, I'm so sorry. My pen and paper. No, but. Thank you.
Bravo. Thank you.
Apart from this. So you're in a steady state when you bring it down, you're satisfied. But then as soon as you decrease, your utility decreases. Yeah, don't know exactly. So it's a like that. No, the government decided exactly. No, no, exactly. So we don't have an objective. We don't have an objective function to show. They just say there's a certain amount of spending. Now, so that's all. Yeah, that's all exogenous. So it's an exogenous decision. Now, how does we basically the first shot when I shift to the United States and it's not already applied. The government
that's what I'm saying.
They know this, but they don't consider that. They just say we're going to spend more. The households know this. The households are the ones who are worried about this. I know what you're saying. We can do it another way, which is where no. So yeah, the decision making. Yeah, we could do that ultrasound. It would be actually straightforward to even say you want total expenditure to be X. So always provided by yes. And then endogenously, if this goes down, this must go up. That would actually be much more interesting. Yeah. No, that's an interesting. Yeah. At the moment, it's all the security stuff is bothering households and firms, but it's not bothering the government. The government just are the yeah. Not the same effect, basically, you would have spend more it would be because it's more capital intense. So there's that, but it's also getting there. Yeah, that's one of the impacts. It's more capital intense. That's down. That's your problem. So it's one. And this money, just labor is labor, and it's just a matter of how to allocate it. Yeah, so if you want to rest on this, now the short over here. You just make the margin the capital. So you just, if you're trying to decide, like it's more optimized. Plus, we have more savings now in the economy because we're cutting back on consumption. No, but this is like, are you talking about? No, everything is about yes. Give me 1 second, I just need to put this back.
L'implémentation à l'entreprise, parce qu'elle a changé énorme. Elle a changé énorme.
The assumptions are right. I just think it off reduce right? And that's the part we need to learn. It's all about what they're so but the same goes what I said, but it's a which is a the big sense of that's a bit so yeah. No, that maybe we got back.
Conference, I really like it. Yeah, very, very interesting and important actions. Like I don't know my tips for that about the museum is exposure. What about next story in terms of defense spending? No, so that's an important item, but what the
Yeah, I tell you.
Like that.
I am part of the organization.
Sorry?
Oh, no, thanks for that. Thanks. Yes. Yes. Yeah. I'm here. I know even.
Exactly.
Okay.
Sure. Just relate that
We just need a couple of more minutes to get the mic on Francesco and Gustav.
Be green, and that's mean you're on.
Okay, now we can start. We're all set. Let me first thank you, everybody, for staying and being here and for participating in this great conference. I think that in this session, we're going to have a very interesting discussion. We're going to touch upon a very critical issue. How do we finance the structural fiscal needs and how does this, what are the implications for price stability and also debt sustainability? And we have two great speakers here, Luke and Francesco, that will present us with two comprehensive and complementary approaches. Luke will actually discuss about how monetary policy and fiscal interaction, how monetary and fiscal policy interacts in this environment of potential fiscal shocks that are not linked to clear adjustment. So the implications for price stability and monetary policy as a consequence. And then Luke will come to discuss about, give us the IMF view and a little bit of his experience from the IMF on what are the implications for debt sustainability, the trade-offs between policies and adjustments and how we should do it. So without further ado, let me welcome and thank you, both of you, Francesco, that he has a work with our colleagues, Giovanni, Ermal, and Costas was there to work with him on the paper on funding and unfunded fiscal shocks, and Luke, who's coming from the IMF, that will try to answer how Europe will finance needs without having the resources to do so. Without any more words from my side, I will welcome Luke to start and give us a little bit on the critical question between fiscal needs and debt sustainability.
Good morning, everybody. Very happy to be here this morning to talk about this paper that we wrote on how can Europe pay for things it cannot afford. The work that I'll present today is quite present some similarities with the work that Philip Rotter presented yesterday. Martin also previewed a little bit, advertised our note yesterday, so I hope there will be still a few pieces of things that you'll be able to chew on during my presentation. So let me start with the motivation of this paper. I will not surprise anybody today if I tell you that spending pressures have intensified in recent years in a world shaped by geoeconomic fragmentation, structural transformation, and global shocks. New pressures come on top of existing ones, and many are expected to increase in the years to come. The starting point of our work is a very simple question. Governments are increasingly asked to do more. How can they pay for these growing needs that exceed what countries have managed in the past? To respond, we take a holistic approach, considering several types of policy responses, not just fiscal consolidation. And we also asked the question of whether a deeper rethink of the scope of public services may be necessary in some European countries. This work, this presentation builds more specifically on two recent IMF papers, a work on the left published in March on long-term spending pressures in Europe, in which the IMF produced estimates of these long-term spending pressures, and a new note that I led on published in November and prepared for the regional economic outlook, and my presentation will mostly be based on the second paper. Let's start with the scale of the challenge. Many countries, as we discussed in the previous sessions, are facing three types of fiscal pressures. One, new policy priorities, for instance, defense, we discussed it extensively, but also energy security. Two, rising interest bills due to higher bond yields and combined with elevated debt levels. And three, an aging population, which continues to drive up health and public pension spending. In our paper, we consider a non-exhaustive set of spending pressures in the areas of health, pensions, defense, and climate. Altogether, these pressures are estimated to increase spending by around 4–5% of GDP on average, depending on the country groups, which is an order of by 2040, which is an order of magnitude found also in similar studies. Our project is based on a 15 years time horizon until 2040, which helps us capture some of these long-term fiscal pressures while remaining relevant for today's policymakers. And this 15-year horizon includes a 5-year medium-term adjustment period plus a following decade for which we denote in the paper as a long term. So 4–6% of GDP on average is not a small thing. And the question is how to foot the bill. As you know well, borrowing more to pay for this additional spending will likely be very costly as the era of very low interest rates is likely over, and it could be potentially risky given that a rapid surge in debt may trigger adverse market reactions. On the other hand, raising taxes to fund higher spending will not be easy. Revenue levels are currently close to historic highs in many large advanced economies in Europe, and taxpayers are still recovering from the cost of living crisis of recent years. Policymakers also face a very challenging political economy environment. As you can see on the chart, voters expect government to spend more to improve public services, but they are reluctant to accept higher taxes and higher debt. And this is not surprising considering the finding that ERAS showed yesterday on the very limited understanding of fiscal policy linkages in the population. If left unchecked, the spending pressures will put public debt on an unsustainable, explosive path. This chart illustrates this point by showing the debt trajectory under unchanged policy, meaning if the primary balance excluding the spending pressures remains constant as a share of GDP, but the debt ratio still increases because the additional spending, of course, add to deficit levels, and this effect grows over time. This is a very stylized exercise. It's not based on IMF projection. It's not a projection, and it does not reflect the country's medium-term adjustment and reform plans. And under this very stylized assumption, what we can see that debt of the average European countries would roughly double from today by 2040, as you can see with the blue line. And if in addition to that, we incorporate the potential effect of the deteriorating fiscal position on growth and raising borrowing costs, the debt trajectory could be even steeper, which is the red line on the chart. So what could be the alternative path to avoid this explosive debt trajectory? So to calibrate the size of the policy response, we have to define a debt trajectory that is sustainable. And obviously, there are many alternative possible sustainable paths. So in our paper, we define what we call the reference path based on a number of assumptions. And one of the key assumptions is the choice of the debt anchor. The European fiscal framework has long been anchored by the need to bring back debt below 60%. And there is an ongoing conversation about the right level of the anchor and whether it should be a hard ceiling
or a long-term convergence point. And here I also quote Lucio's paper, recent paper. For this work, which is illustrative, we estimate the anchor based on economic analysis rather than by relying on country-specific institutional frameworks. This simplifies the calculations, and this allows us to apply a common methodology to 45 countries, which all have different frameworks. How do we do that? The IMF has developed a range of tools to calibrate the debt anchors in the past decade. And the general approach is to set the anchor at a level that is sufficiently low so that even in case negative shocks hit, debt will remain in safe territory. And the calibration is usually conducted in 2 steps. The first step consists of estimating a maximum debt limit, a cliff, that should not be exceeded without endangering fiscal sustainability. And then the second step sets the debt anchor below the limit to provide a buffer so that if adverse shocks occur, debt would remain below the limit with high probability. And Era mentioned yesterday some recent work of the Fiscal Affairs Department, including Xiao's work on debt limits, and 𝘊𝘶𝘶𝑟𝑖's and others that on work on debt at risk, which we also use to calibrate the buffer. So we applied for Europe these 2-step approaches with actually a broad range of methodologies for robustness, and we found a debt anchor of approximately 90% of GDP on average for the region, with 105% of GDP at debt limit on average and 15% buffer on average. This anchor is notably higher than the 60% of GDP threshold of the European Union. This difference could reflect many things, but actually at least one thing: there has been an increasing debt carrying capacity in many countries over the past 3 decades due to the deeper financial markets, larger government revenue base, and lower borrowing costs compared to the 1990s. For illustrative purposes, we apply this single anchor across all countries. So in practice, debt anchors, of course, are country-specific, but this is not the purpose of our analysis, to do country-specific analysis. So the next question is how to use the anchor in order to obtain a reference debt path. And there are many ways of implementing a debt anchor. We assume a framework that has become the norm in many countries, where debt is supposed to stabilize in the medium term and then be placed on a downward path in the longer term. So we apply the anchor in a soft manner. It's not a hard convergence point like by a certain date, like for instance an S1 indicator. And another important assumption is that high debt and low debt countries do not have the same path, are not assumed to have the same path. There is so an asymmetry in the way we apply the anchor. Countries with debt currently above 90% are assumed to target debt stabilizations over 5 years and put it on a declining path in the subsequent decade. But countries with debt below 90% of GDP are assumed to keep fiscal policy unchanged, meaning that they accommodate the long-term spending pressures without otherwise changing fiscal policy. Then we pose a very simple question, but very complicated question. Is there a combination of policy tools that can bring the debt trajectory from the explosive red line that you see there to the sustainable blue line? So that's the main focus of the paper. So what is this policy package to meet the financing challenge? We consider policy packages based on 3 main pillars. The first pillar are structural reforms. They have 3 main functions in this context. One is to increase the government ability to handle the pressures by boosting economic growth. So think about a product market reform. 2, some of these structural reforms tackle directly the spending pressure. Think about a pension reform, for instance. And 3, some structural reform alleviate the burden falling on national budget. Think about, for instance, a centralization of spending at the EU level. So that's the first pillar, structural reform. The second pillar is a more traditional one, medium-term fiscal consolidation measures, both on the revenue and the spending side. And third, if reforms and medium-term consolidations are insufficient, Then more radical fiscal measures could include reassessing the scope of public services and other government functions, potentially impacting the social contract. And that's what we call in our paper the rethink of the role of government. We recognize that there is some overlap between the three pillars, and that there is also a degree of judgment on how you classify measures in one of these pillars, especially between the fiscal consolidation pillar and the rethink of the role of government. I'll be happy to discuss that if you have questions. So now I will explore the impact of these three pillars sequentially. So let's start with the structural reforms. So we consider a set of structural reforms, both growth structural reforms, but also fiscal structural reforms. These reforms have been selected based on their macroeconomic and fiscal relevance, as well as the availability of studies quantifying their impacts. It's not an exhaustive list. These reforms actually for us, have been supported by recent IMF papers, which have estimated their impact. I won't have time to describe all these reforms in details, but the references are in the paper. So if you're interested, you could also have references to the original papers. But the main point that I want to make here is that we consider we could incorporate in our debt simulations a very large number, a large range of structural reform, both national and supranational. You could think a little bit about it as a wish list of the European Department of the IMF, you know. And you have domestic growth reform that Era mentioned yesterday in a presentation from our recent work, to single market deepening reforms, some recent work also on the centralization of European public good provision, and of course pension reforms, and also reforms on catalyzing private investment. So we put all these reforms in our debt dynamic equation. It's not a purely mechanical exercise. There are a lot of feedback effects that we take into account, including the multipliers. And what we find is that structural reforms, as expected, would significantly reduce the strain on national budget. And the objective of our paper was to think, okay, but how can structural reform contribute by how much compared to fiscal consolidation? You know, sometimes people say structural reform are important, but you don't really know the order of magnitude. And we find that if all the wish list of the IMF was implemented over the next 5 years and begin to pay dividends over 20, 30, 40, what we call the ambitious package, this would bring the debt trajectory of the average European country about half of the way towards the reference trajectory. This is a blue line. And if the package of reform are only half as ambitious, which is already quite ambitious, I must say, then we call it moderate reform package, then the fiscal impact would be smaller, but it would still bring the average European countries 1/3 of the way towards the reference debt trajectory, which is a yellow line. And in a sense, you need to think about this moderate package as being a bit our benchmark within our department. So the idea that perhaps 1/3 of the problems could be addressed through structural reform, and then you have this 2/3 that left to fiscal policy. In terms of contribution, while we look at individual measures, we found the largest impact coming from pension reforms and growth enhancing domestic reform. Second pillar, fiscal consolidation. Reforms alone will be insufficient to meet the rising spending needs in the majority of European countries. And medium-term fiscal consolidation has, of course, a very important role to play. In our simulation, we assume consolidation would occur over the next 5 years to build buffer that can help countries absorb future spending pressures. And the simulation show that consolidation is needed in close to 3/4 of European countries to achieve the reference debt path after implementing the moderate package of reform. In these countries, the required fiscal adjustment would on average entail an improvement in the cyclically adjusted primary balance of 3.5% of GDP cumulatively over the 5 years. The scale of consolidation seems feasible. We did also some analysis to see what European countries have been able to achieve in the past, summarized in this table. And in the last 3 decades, the median consolidation episode in European countries has delivered a CAPB improvement of around 1% of GDP per year for only 3-4 years. So in general, so basically our conclusion is that for the average country, fiscal consolidation could close the gap, basically. I would just want to flag that in general, in our estimates, our adjustment needs estimates are larger than the consolidation path under the EU fiscal framework with the MTF-SP. The size of the required fiscal consolidation depends, of course, on the ambitions of reforms. More ambitious reforms have a larger fiscal impact, first because of the additional increase in GDP and revenue that they generate, but also because of the greater reduction in the spending pressures, since often some of these structural reforms directly tackle the spending pressures. And together, this lowers the amount of fiscal consolidation required to achieve the reference debt path. The figure here shows an isoquant with different combinations of reform ambition and consolidation size for the average European countries, assuming that it achieves the same reference debt path. And just our simulation shows, for instance, that when you increase the reform intensity from moderate to ambitious, this reduces the cumulative consolidation needs for the average countries by about 1% of GDP. So it's a very stylized exercise, but it shows that it's also possible, in a sense, to quantify the trade-offs between consolidation and reforms. In practice, for the vast majority of countries, the combinations of reforms and consolidation will be needed, and this combination is ultimately a decision for each individual country, since both policies are politically costly. Both reforms and consolidation are politically costly. For countries that already have high level of debt, reforms and conventional fiscal consolidation measures will not be enough to align spending with needs with available resources. This chart shows the average adjustment needs in the top quarter of the countries with the highest adjustment needs. So the top quarter of the countries where the adjustment needs are the highest. We assume our 90% debt anchor. And initially, the adjustment needs in the red bar without any structural reform would be around 8% of GDP. But even if you add the structural reforms, the moderate package of reform, and a traditional 3–4% of GDP medium-term fiscal adjustment, a gap would remain, which is the last blue bar on the right-hand side of this chart. And in these countries, our view is that a discussion on the scope and sustainability of the European model seems unavoidable. There is still a lot of work to do, including at the IMF, on understanding and providing advice on this large adjustment that involves changes in the scope of public services, the social contract, and the split between public and private financing. Some countries like Canada or Sweden have been successful with these large adjustments in the past, and lessons can be learned from these experiences. It's a very complex, sensitive discussion, but just one point that I would like to make here, that the savings created by rebalancing the private public split are potentially significant in Europe. So to illustrate this point, we have collected data on public-private financing by country, for each country, in health, education, pension, infrastructure, and climate. And we compute the savings generated if the public financing shares in countries above the OECD average align with the OECD average. So it's a very simple exercise. It's not normative. It's just saying what happens if you go to the OECD average, basically. And we find that this could generate fiscal savings of close to 3% of GDP per year for the average European countries. Yeah, I'm concluding. So now conclusion. One is failing to act promptly will exacerbate the problem. The longer that reforms and constitution are delayed, the more spending pressure will worsen the fiscal position. This will raise future adjustment needs and make it more likely that the market will eventually force the adjustment, which could be disorderly and not reflective of public preferences. And to illustrate this point, we replicate the previous results, but delay the implementation of the policy package by 5 years. And we find that the adjustment needs increase from 3.5% of GDP to 5% of GDP. And lastly, my final slide. So just concluding, how to pay for all these new spending needs. So I would just like to leave you with 4 thoughts. One is that, in our view, there is no silver bullet. A multi-pronged strategy is best. Leveraging all tools at the national and regional level. Sometimes in the policy debate, some measures like, I don't know, mobilizing private finance, joint EU financing are sometimes presented as game changer, but our analysis suggests that no one measure can close the financing gap alone. Second, reforms and fiscal policy should be combined. Both are necessary in most European countries, and both entail adjustments that could be politically costly. The greater the progress on reforms, the less costly will be the tasks of fiscal consolidation. Third, we should anticipate difficult choices regarding the role of government in the coming decade. Even with bold reforms and fiscal discipline, financing gaps are likely to persist, especially in high-debt countries, and this will leave little choice but to adapt socioeconomic models and make deeper reprioritization decisions. And finally, extensive public consultation will be key. In our view, it's important to initiate a public discussion about the scale of the problem, the policy response, and the consequences of inaction. Communication has been a component of successful large policy adjustments in the past, and it's particularly important today since there is some misunderstanding in the public debate about the size and the solution to the fiscal challenges. Thanks so much.
Okay, thank you so much. I don't know if my mic is open. Francesco.
So thanks a lot for having me here. So there was a bit of insider trading, as you can see from the list of co-authors. So this is joint work with Giovanni, Ermal, and Costas, and they should take most of the credit for what I'm going to present now. So I also changed the title. I tried to make it a little bit simpler compared to what we had in the program, and also a little bit more suggestive about what we are trying to do here. So we are interested in understanding the link between fiscal imbalances and inflation in the euro area. So the reason why this is slightly more complicated than, for example, for the US is because in the euro area, there is one central bank for multiple fiscal authorities. And so this, of course, creates the problem of exactly which fiscal authority is driving inflation, or which fiscal authorities are driving inflation. So in order to answer this question, we're going to build a quantitative model of the euro area with partially unfunded debt. So this builds on some previous work that I have with Renato Faccini and Leonardo Melosi, and an extension that 𝘧𝘁 and Wouters had done on that work. And I'm going to try to explain exactly what we did in the first paper and what 𝘧𝘁 and Wouters did in the second paper for the US. So what we're going to show is that unfunded fiscal shocks, meaning shocks that are not backed by future fiscal adjustments, mostly originate in the high debt region. These unfunded shocks that generate debt that is not backed by future taxation is going to generate inflation for the whole euro area. So it's going to generate inflation both for the high debt region and for the low debt region. While what we see for output is that the spillovers are much less evident between the two regions. The other interesting aspect of this is that, and this is similar to previous work, is that this unfunded spending that occurs is going to drive the low frequency component of inflation, in other words, the persistent component of inflation. So let me give you a brief overview of the model. So I only have 20 minutes and I was late, so I definitely cannot exceed my time. So we have a two-region model, and in each region there are two agents. So these regions are defined as countries that have high debt versus countries that have low debt, where we split them based on the median over the sample that we consider. Of course, as we know, there have been some countries that have been drifting away from being low debt to being high debt, but at the moment we keep this partition fixed. So in each country, there is a hand-to-mouth agent and a Ricardian agent. So in this sense, it's similar to other tank models that you might have seen before. There are all the typical ingredients that you find in Keynesian models, meaning monopolistic competition, adjustment cost, price rigidities, and so on and so forth. So it's a very rich model, but I would say on purpose, because given that I'm going to argue that there is an important component of inflation coming from the fiscal side, we want to make sure that we don't accidentally forget a potential driver of inflation that the literature has found to be important. So what is the twist in this model then? Well, we are going to allow for partially unfunded public debt. What that means is going to allow for the possibility that there is a certain amount of spending or a certain amount of cut in taxation that is not backed by future fiscal adjustments. And not surprisingly, something else will have to give, and that is inflation. So let me try to give you a little bit the sense of what we do. I think it's relatively simple once somebody explains to you how it works. It's a little bit cumbersome when you start thinking about this from scratch. So on the very top, we have the government budget constraint. So on the left-hand side you have the debt to GDP ratio and the tax revenues coming from different sources. On the right-hand side, you had the debt that you carry from the previous period plus the amount of spending in the current period. In the second part, we have fiscal instruments, and here the relevant part of these fiscal instruments is that they all react to the debt to GDP ratio. That's the SB that you see over there. But if you notice, they react to the debt to GDP ratios in deviations from this other SB variable that is unfunded. So the UF here stands for unfunded. What that means is that there is a portion of the overall debt with respect to which there is not going to be a fiscal adjustment. So as I was saying, something has to give if there's not going to be a fiscal adjustment with respect to this remaining portion of debt. And essentially what's going to happen is that the central bank is going to accommodate the amount of inflation that is necessary to stabilize debt. And so you see this in the policy rule in which we react with a coefficient gamma pi to the amount of inflation in deviations from what we call fiscal inflation. That is the amount of inflation that is necessary to stabilize debt. Now, if you set the second part, the red coefficient over there, to 0, you effectively have a Taylor rule with a time-varying target for inflation, in which, on the other hand, the time-varying target is endogenous with respect to the structure of the economy. It's not like an exogenous process. So the idea is that the central bank is going to react differently to inflation depending on whether it's needed for fiscal stabilization or not. So how do we keep track of how much inflation is needed? Well, this is similar to what we do when, when we keep track of, let's say, potential output. We don't really observe it. We reconstruct it within the model as, let's say, the level of output that would prevail absent nominal rigidities. So here is slightly different. Instead of thinking about, I want to look at the counterfactual economy in which prices are flexible, I want to look at a counterfactual economy in which the only shocks that occurred are these unfunded fiscal shocks. So this is almost like an accounting exercise. It basically tells me how much inflation I need to stabilize that portion of debt. So again, pretty simple once you figure it out. It took us some time to understand how to do this. Sorry, this froze. Oh, okay, it's moving again. Okay, so then the last part is about understanding what generates a technically. Okay, we can think about this at the heuristic level, and then we can think about this at the technical level. So technically, the way you want to do this, every time there is a shock hitting the economy, there is a certain share of that shock that is not going to trigger a future fiscal adjustment. And this, again, can work in both directions. It can be that there is an acceleration in growth for which debt becomes more sustainable and that lowers inflation. And at least in the US, we see experiences like this. And as I'm going to show you, there is something similar happening in Europe between the financial crisis and COVID. So you can do this in two ways. So Smets and Wouters show it two ways to do this. One is to say, well, each shock has a fixed share of spending that is unfunded, and the other share is funded. In my own paper, we did it differently. We were allowing these shocks to be potentially uncorrelated. So we wanted to allow for the possibility that there are some periods of time during which the government is less fiscally responsible than not. As I'm going to show you, the results do not change dramatically across the two specifications. So I'm not going to spend more time on this than what I just said. Okay, good. So let me jump straight into the results. Okay, so remember, there are all these shocks hitting the economy. Some of them are going to trigger future fiscal adjustments. Some of them are not. So what we are interested in is, first, are these unfunded fiscal shocks unfunded shocks important? And if so, which countries they are coming from? So the important thing to consider here, and this is the key contribution of Smets and Wouters with respect to what we did in my previous paper, each shock has fiscal consequences. All shocks that hit the economy have fiscal consequences. So what we are doing in these graphs, we are putting together all the shocks that trigger an unfunded level of spending. Again, it can be in both directions. Or that is not followed by future fiscal adjustments. So what we are interested in are the dark blue areas in this graph. So let's focus on the dark blue, the very first one, and then the slightly lighter blue. So these are the shocks that hit the high debt country, and the light blue one is the unfunded component. So what you can see from this graph is that both for the high debt country and for the low debt country, this unfunded fiscal shock in the high debt region, sorry, I shouldn't say country because these are regions, are group of countries, drive inflation in both areas, in both regions. It's particularly evident in the high debt country, but it's, again, in the high debt region, but it's also there for the low debt region. The other thing you can notice is that the aquamarine or emerald green, that would be the low debt unfunded fiscal shock, it doesn't show up anywhere. So what that means, practically speaking, is that inflation in the euro area is to a large extent driven by unfunded shocks that hit the high debt region, and they are essentially accommodated by the central bank. Now, this is the kind of result that if I explain to my mom, she would say, did you need to write a paper to find this out? Well, in a sense, yes, because we all have our views about what happens in the euro area, but there is a difference between having an idea and then show it formally. So I think like I would say the surprising results is that they very much align with what would be your intuition. If I asked you before presenting the paper, you would have probably thought that this is pretty obvious. The other thing that it's important to notice is that when it comes to the low debt region, inflation has a big component coming from these unfunded shocks in the high debt region, but there's still an important share that is driven by shocks in the low debt region, but these are all funded shocks. So in other words, there is not much of fiscal inflation coming from the low debt region. The other important result that comes out from this graph is that there are two phases, in a sense. If you focus on the period between the global financial crisis and COVID, you can see that this fiscal inflation is actually driving inflation down. So you see that these dark blue bars between the global financial crisis and COVID are actually driving inflation down. Again, this is when we think about this makes perfectly sense because between these two events, the focus was on austerity. There is a dramatic shift there was a dramatic shift during COVID with respect to what to do, probably because this was a global shock and the idea that Europe could enter a second financial crisis was real. And so we had a dramatic shift, and now all of a sudden this fiscal inflation changes sign dramatically and drives almost the entirety of the run-up in inflation in the high debt region and around half of the low debt region. Okay, this is an historical decomposition for inflation. If we do the same thing for growth, the results are quite different. In other words, for growth, we don't see much benefits of this fiscal inflation. And this is a little bit different from what I personally found for me and my co-authors, of course, what we found for the United States, in which instead the COVID fiscal stimulus generated a massive rebound in the US economy. This is an interesting result, and in part it stems from the fact that while in my analysis for the US, we were focusing on fiscal shocks exclusively, here we are focusing on all shocks and their fiscal consequences. So the reason why it's important is because you can have a shock that is still contractionary, but is going to lead to a lot of inflation. And so that's why perhaps the results are different. So we are digging a bit more into this aspect of the model. By the way, this is the first time I presented, so we are still very much trying to analyze all results. So now, these were historical decompositions. Suppose we ask in population how important these fiscal shocks are. What I mean is like, suppose we ask what is the contribution to the variance of these variables at different horizons. So this is the typical variance decomposition. But the difference here, again, normally the way you do a variance decomposition, think like, okay, there is a demand shock, there is a supply shock, and so on and so forth. So here, instead, what we are doing, we are grouping again all the shocks that are funded backed by future taxes and all the shocks that are unfunded, and asking what is the relative importance of these shocks for output inflation and debt variability at different horizons. And so in the interest of time, I'm just going to focus on output and inflation. So what you can see is that for both for the high debt country and for the high debt region and for the low debt region, these high debt unfunded shocks drive the bulk of inflation at the infinite horizon. So what that means is that the unconditional variance of inflation is mostly driven by these unfunded shocks. So in other words, the persistent component of inflation is driven mostly by fiscal considerations. When you look instead at shorter horizons, the region-specific shocks that are funded are a bit more important. The second thing that it's obvious, again, is the large contagion between the two regions in terms of unfunded shocks that originate in the high debt country. So what that means is that inflation, both in the high debt region and the low debt region, is driven by these shocks. When you look at output, we find a similar result of what we saw in the shock decomposition. We again find that for output, these shocks do not seem to be as important. So this is interesting because there's a little bit of a Fisherian flavor. It's almost like saying that, unlike in the US, these shocks do not really seem to, in the end, have a big impact on real activity. They mostly translate into inflation. Okay, so let me focus on the two shocks that we find to be particularly important. So the first one is an unfunded tax shock. So what does it mean, an unfunded tax shock? Well, it's like to say you have a tax reduction with no intention to undo it in the future, or with tax increases, or with spending cuts. So as you can see, this shock is expansionary. Okay, so you get an increase in GDP and you get an increase in inflation. What is interesting is that you get a decline in the debt to GDP ratio. So the reason why this is happening is that real interest rates drop and output goes up. So the denominator, in a sense, goes up, and you actually get a decline in the debt to GDP ratio. Now, in this graph, the blue line refers to the high debt region, and the red line refers to the low debt region. What is the difference between the solid lines and the lines with the little circles? Well, in the lines with the circles, I'm making the share of this tax cut more unfunded. So I'm making it a 10% increase in the level of lack of fiscal backing. And as you can see, as I make it more unfunded, as I essentially assume that a larger portion of this shock is going to be stabilized through inflation, you get exactly what you would expect. You get a significant increase in inflation. So this shock is in a sense similar to what I found before. However, there is another shock that also plays an important role that has very different dynamics compared to what somebody could expect a priori. So this is a shock to the marginal utility of households. So it's the typical shock that we use in New Keynesian models to generate a recession coming from the demand side. And in fact, that's exactly what you get. You see that you get a recession, GDP goes down, inflation goes down. So despite the fact that it's unfunded, so that's a little bit the surprising aspect. So what I mean is, like, despite the fact that the central bank is willing to accept inflation to stabilize this shock. So the reason why this happens is because in the short run, the shock is able to push the economy into a recession. The debt to GDP ratio actually increases on impact. You start accumulating more debt, and spreads go up because in this model, there are financial frictions that depend on the amount of debt that you have accumulated. And so as a result of that, in the short run, despite the fact that the central bank is willing to accept higher inflation, the output goes down and inflation goes down. So the interesting thing now is that the larger the share of the shock or the fiscal consequences of the shock that the central bank is willing to absorb, the larger the increase in inflation in the long run. Okay, so this is a situation in which, given that the recession gets deeper, you accumulate more debt, and then eventually you're going to end up with more inflation. And this type of shock can also explain perhaps why for the euro area, we get that a lot of effects are on inflation, but not so much on output growth, because here you see that output essentially simply goes back to zero, while inflation is then used to stabilize the debt that you have accumulated in the meantime. So I'm done. So I was on time. So what are the conclusions on the studies? So fiscal inflation play a key role in the euro area, like it does in the United States. However, the key difference is that the euro area is a monetary union, everybody knows this, and fiscal inflation in the euro area is mostly driven by unfunded shocks that occur in the high debt region. So this reminds me a little bit of some work I did with Robert Barrow, in which we show two things essentially. First one is that you can explain the cross-sectional variation of OECD countries' inflation post-pandemic based on the size of the fiscal stimulus, rescaled by debt and duration. But then there is a second result toward the end of the paper that we show for the euro area. Controlling for the amount of spending in the individual countries is irrelevant. What matters is the spending in the whole euro area. While on the other hand, output spillovers are modest despite the strong inflation spillovers. Thank you.
Thank you very much to both. I think that they were very, very interesting and insightful approaches to this spending pressures. I have one question, also being mindful of the time. I have only one question for you. Defense spending, permanent shock. You both from different angles discuss the implications for additional spending and higher debt. What is the point that you would start being concerned in terms of growth, the different variables, growth, inflation, and debt that would actually could trigger a market repricing of risks? Because you have in your model, you saw that there is an impact on spread. Obviously, look also when you discuss about sustainability is about having sustainable market financing. So at what until now, and although we all discuss these challenges and these risks, we still see very, very benign market conditions for European countries. What is this combination of information, events, and actual data coming in that you would make you feel concerned and you think that it could have this kind of sudden repricing? I don't know. Luke, do you want to start?
Well, first, if I knew, I mean, it's a very complicated question. What we show is that debt is on an explosive path. So obviously, this is a source of concern first. I would look at it, but just beyond defense for all types of spending pressures. I mean, a few things that make me feel hopeful and a few things that make me feel concerned. One thing that make me feel hopeful is that some of these spending pressures are very gradual in the way, maybe defense is a little bit different, but it's increasing. You saw the chart, it increased in a quite gradual way, and it's anticipated. So from a market perspective, usually markets do not like surprises, you know, and they sometimes react to surprises, to negative surprises. So I think given that it's very gradual and anticipated, this is for me a source of, I wouldn't say reassurance, but at least it's a mitigating factor. The second mitigating factor is also that it impacts most countries as well. So usually market, they like to make differences across countries, you know, they like to differentiate. And so I guess if these spending pressures affect all countries, not in a very similar way, but basically debt increases everywhere, I guess it could also be a mitigating factor. However, on the other hand, countries may actually react in very different ways. So what may happen in the future is, as I showed, depending on the type, especially of structural reform that are implemented, you may see extremely diverging debt trajectory, with some countries having that really on an explosive path and other being able to manage them. So that's where I think you could see actually market reactions. And perhaps the last point is also, you know, I presented to you some estimates of debt limits. I think this discussion on debt limits has become a bit out of fashion. You know, it was very fashionable after the global financial crisis, and people were saying, oh, 90% is not relevant anymore. Even the EU framework moved from, you know, being anchored on numerical targets to something where basically these numerical targets on debt are less important. I would not be surprised in the discussion on that limit resurfaced if there is a market event, you know. And when we do this analysis on debt limits, even though it's very uncertain, there are big ranges, I can imagine a range of debt levels that are really unsafe, and I see some countries reaching this debt level. So it's a source of concern for me.
Thank you. Thank you very much. Francesco, if I may ask you in your answer to also reflect a little bit from your analysis and the framework that you nicely presented, a little bit also the aspect of the monetary policy fiscal interaction. You know? What are the implications for monetary policy in view of increased defense spending and especially with these inflationary pressures from a permanent shock?
No, absolutely. So I think the problem is that compared also to the analysis that we saw here is that the pressure is only in one direction. What I mean is like we know that we already have increasing spending ahead of us for transfer policies, and then we want to add the military spending into it. And to be honest, I feel like military spending at this point is a necessity. It's not a choice anymore. So compared to what we saw here, in which, as I was pointing out, sometimes fiscal inflation goes down, sometimes it goes up, and so perhaps markets have not freaked out because of that, meaning that we also came from a long period of time during which the inflation was the issue. It's a little bit less clear that going forward we can count on markets being as optimistic, because once they do the math, they might realize that this doesn't hold, you know, that something has to give. So it's possible that there is still a certain level of confidence that eventually fiscal adjustments will be done in the direction of acknowledging that if we want to have a higher military spending, we'll have to probably reduce benefits somewhere or increase taxes. But I just feel like in Europe, that's a little bit of a hard proposition given the high level of taxation. And the other thing that concerns me is that, so Luke gave us this very nice analysis with these different scenarios. And something we were reflecting with a colleague of mine, Domenico Giannone, who used to be at the IMF, which stole from the IMF, is that the risk is, again, very asymmetric in the sense that if you hit a bad recession, this is going to have a discrete jump. And the only reason why today we are not in a worse situation is because we got a lot of inflation. So these are the aspects that worry me, in a sense that eventually markets might start pricing the fact that fiscal inflation will be more likely to be positive than negative. And once they price that in, we might end up with the typical inflation bias story for which we don't even get that minimal level of stabilization that generally comes with inflation.
I have a lot of questions in my mind, but I think it's time for the audience. I mean, if you please feel free. Angela?
Thank you very much. And I have actually a mix of a comment and question to Luke, and perhaps also to offer a bit of a slightly different perspective, if I may challenge you. I think that, I mean, I like very much your presentation, and I think we totally, at least from the European Commission side, share the diagnosis that there is an upward trend in debt, and that a number of policy actions are needed, and you clearly depicted all these policy actions in your last slide. So I think that I totally concur with you. Though I think where I very much differ from you is on the size, on the amount of the problem, and I will also come back on the policy. And on the size, I think you have been saying several times explosive debt trend. And I mean, you clarified that indeed this is at unchanged fiscal policies. But even though at unchanged fiscal policies, the size of the issue that we see from the European Commission side when we look at EU member states, and that perhaps there is a difference because you very often refer to EU average countries, so probably you have a very different aggregate, and so probably this has to be made clear because I had the impression that in the EU aggregate we may have even Belarus, Ukraine, Russia, but when we look at the EU member states, yes, at unchanged fiscal policy, debt is on upward trend, but it will stay in the medium term below 100% of GDP, which is a very different size of the one that you have given. And this is when already taking into account the aging cost, because as I said yesterday, these are taken into account in our framework. I explained yesterday that we estimate the impact of defense expenditure to a 3 percentage point. And okay, again, tomorrow at 3 p.m., my unit will publish a new paper on the impact of climate change on the DSA. And still, I mean, of course, there is an impact, but we are talking of a very different size of the issue. We are really at around 100%. So we would not talk about explosive trends. And as I said, probably the fact that you consider a different aggregate of of European countries, I think also you have a different assumptions on permanently positive stock flow may explain why we differ. And then when it comes to the policy solution, yeah, again, we very much concord that, okay, the first layer is a fiscal consolidation. There probably am a bit more optimistic, or at least less pessimistic than you. We have just now received the draft budgets from member states, and most of them are adhering to the medium-term plan. I think this is a very good news, because basically it means that this political commitment is starting delivering. They have the medium-term plans, and at the first implementation, they are adhering to basically the target that were given. So I think this gives hope for the future. Surely this plan will not exhaust the consolidation needs. There will be need for other plans, but I think that we should be positive about that. And the very last point, I want to challenge you on the perimeter of the state. I mean, this is a super long discussion. We won't have time, but there is one thing where I picked when you were talking about the health sector. Yeah, it has to be made more efficient. But I mean, coming from a unit that looks very much at the aging cost related to the healthcare system, I mean, our risk scenario tells us that actually if the population is aging in health status, so if we have health longevity, this is actually going to help public debt sustainability and growth. So I would be very wary and cautious to recommend a reduction of the state role when it comes to the health sector. Thanks a lot, and sorry that it was a bit of a long intervention.
So very nice presentations, both. I have a couple of questions and a comment for Francesco. First, just sort of are there asymmetric effects in your framework, not just in this paper, but in previous papers, when you show the effect of government spending cuts as compared to sort of the tax side? Are there two very different things? Second, I wanted to press you a little bit more on sort of what role the monetary fiscal interactions aspect of it. I mean, if you were to sort of stretch the argument, does this necessarily mean that you're going to abandon some part of your, you're no longer thinking about a 2% inflation target? Are we moving farther and farther away from that in order to accommodate all of these spending needs? And then related to this, how should we think about expectations or inflation expectations? What is happening to inflation expectations in this world where spending pressures are large and central banks will be much more accommodative? I mean, in fact, our paper, as you know, shows that people who have lived through past episodes of very, very high debt tend to be very pessimistic about how governments will bring down debt. In other words, they think that inflation will inevitably increase. But what does that imply for monetary fiscal interactions?
Do you want to take these two answers and then we go again, one more round?
Thanks. I have a question to Luc. First of all, a great presentation. Really, I like the paper a lot, especially this attempt to show the trade-off between the impact of structural reforms and consolidation. But when you talked about consolidation, you compared the consolidation that the average consolidation that you derive in your approach with the average consolidation of the past. If I'm not mistaken, but that's the question. You included in the average past consolidation periods program periods, where countries, especially Euro area countries, were forced into really tough consolidation. Now, I'm saying this because there is this sort of rule of thumb that more than 0.5 consolidation per year in the cyclically adjusted prime baseline is not feasible. It was also one of the motivations for the reform, because at least in Brussels, it was said, more than 0.5 per year you cannot achieve. While your average consolidation that you indicated is more than that. The second point and last point, you said something that triggered my attention. You said that we need to implement these reforms and combine with consolidation, maybe in different combinations, because the alternative is disruptive and is not in line what voters want. We recently had an exchange with the Euro area staff team of the IMF in Brussels, and there, when we asked question about France, the IMF side was about, it seems that in France people do not support any orderly, if you like, corrections. So how do you see that? Thank you very much.
Yeah, good. Go.
Thanks very much. Just a question for Francesco. So obviously we can't let it go unsaid, but the central bank's willing to accept high inflation. There's enough of us in the room that somebody has to. No, my question is on this aspect, right? That the central bank just lets it go, right? And I was just wondering if you don't assume that, if you assume that they actually care about their inflation target, then in the mechanism, like you have prices that move faster than quantities. So it takes time to issue debt, right? Normally, you don't issue it all in one go. You have a schedule for the year.
Right.
But as soon as you make the announcement, and we showed this yesterday, maybe it was you, man, where when the German announced the fiscal expansion, all the prices went up straight away. Okay. So it was Ethan, sorry. So I'm wondering now, if you have a central bank, you see this inflation forecast go up, they raise interest rates. Now it kind of undoes some of this. So I'm just wondering about how this would work in your framework. Thank you.
Okay, so let's try to respond to these 4 first questions. 2 for you, Luke, 2 for you, Francesco. Francesco, do you want to start?
Yes. So let me start from the last one. I didn't have right to write down. So we don't assume that there is zero response to inflationary pressure. We assume that there is a response that is weaker than what you would find if everything were backed by future taxes. Okay, so it's like I was pointing out before, it's almost as if you had a time-varying inflation target for which sometimes, for example, in your example, the central bank will react less than what it would normally do if this shock were coming from another source, if it had a different nature. Now you pick Germany, that it's an interesting case because, of course, they are it's in our analysis is part of the low debt region. So, and I want to be clear, we're not saying that the only way a shock can have inflationary consequences if it's unfunded. So that's exactly why you need a structural estimation to figure out which channel is at work. The way you want to think about this is there is a certain amount of inflation that has a fiscal nature, meaning that is there for the need of stabilizing debt. That doesn't mean that other shocks cannot move inflation. We know perfectly. And importantly, suppose that we had the reality is one in which this never happens, that the central bank is always committed to a 2% inflation target, and that the fiscal authorities are fully committed to future fiscal adjustments. So then we would have estimated that this lambda, the share of funded versus unfunded, is 1, meaning that it's all funded. So let me go to Era's questions I wrote down instead. So yes, yesterday Ricardo, for example, gave us some evidence that long-term inflation expectations became way more sensitive to news in recent years. And the way, so in this class of models, we play with the rational expectations, full information sandbox. But even in our analysis, we know that there is a small segment of the population that is older and, most importantly, financially wealthy that actually pays attention to this news. And so now the interesting thing is like how you bring that kind of intuition into a model while keeping together the whole general equilibrium aspect. So, but I think it's an interesting venue for future research to think about which expectations really matter. Okay. There are definitely asymmetric effects of different shocks. So there are some tax shocks. Suppose I cut taxes. This connects also very well with Luke's presentation. You might have a fiscal reform that actually it makes the economy more productive, more efficient. And so the fiscal consequences there are moderate, if not positive, meaning if you restructure the tax system in a way that will generate more growth, potentially there is no need of any fiscal inflation. So again, that's why the structural analysis helps here. And of course, like any other structural analysis, conditional to the model you bring to the data, but there are identifying assumptions allow you to separate these two channels. And the other question was excellent. Are we giving up on the 2% target? And this connects to the question we discussed in the very beginning. Yeah, what worries me is that if at some point these shocks only occur in the same direction, and there are reasons to be concerned about that, because the other big change that we are observing these days is a move away from globalization. Then eventually you will end up with a higher inflation, but without any real benefit. It's the typical inflation bias story, for which if markets realize that, well, maybe in the future the implicit target will be 2.5% or 3%, this will be fully anticipated, priced in, and you won't get any benefits from a little bit of extra inflation. So I hope not, but there is definitely a little bit that sense that policymakers are, in some cases, openly discussing, well, what's the big deal with 3% inflation? Well, in itself, nothing. It's just you promised 2%, and now you're saying 3%. And so then, of course, people might say, well, maybe next time you will tell us 4%. And the other, sorry, I want to conclude by saying, with respect to globalization, when we dig into the analysis for the United States, we see that there is a force that pushes inflation up, that is fiscal policy. And then there is a force that pushes inflation down, that in the model, it turns out to be a cost push, a persistent cost push shock. The way we interpret this is that this is essentially an increasing level of integration with the global economy that keeps prices low. In the moment you remove that, in the moment you want to decouple from China, you don't really know what that's going to do to inflation. And I'll stop there. Yeah.
Thank you very much. Luke?
Okay, so first, perhaps to respond to Angela, thanks so much for bringing your
presentation,
for bringing your perspective. I think it's fair to say that we have a slightly different view on that. And I must say that one of the questions that I had when we did our adjustment need calculation, they are based on a different country sample first. So I think it's very important. We have 45 countries. We have countries that are not in the European Union. I work personally as a mission chief in a country that is not in the European Union, where there are large adjustment needs. So I can imagine that some big countries can also distort the comparison. I think we also include a lot of things that I don't know, because I don't know exactly how you do these simulations, but we include stock flow adjustments, which we have seen in the past having been really problematic in debt forecasts when they are not integrated. So we incorporate them, we incorporate multipliers, a lot of things. So I don't doubt that you do it as well. But one of the questions that we had is that the adjustment need that we found were significantly larger than the one of the medium-term plans. So that was a little bit one of the questions that we asked. It's a bit difficult to tell. We should actually compare, and these are complex exercises. What I can tell you is that at least one thing that we do, which is different, is that we include more defense spending pressures than in the original medium-term fiscal plan, because we updated it. So, but it's definitely an open question to know why there is this difference. We believe at the fund that this issue is very severe. Maybe the term explosive is a little bit, I understand, problematic in certain ways. I mean, I don't think that the fact that debt could be at 100% contradicts the fact that it's explosive. You could have something explosive, but because we look just at the 2040 time horizon, if you have something that increases from a very low level, it could hit 100. But so it would be interesting also to extend the forecast further, but we did not see in many countries like clear trend of stabilization. But you're right, there is a lot of country heterogeneity. Maybe I would like just to emphasize one point on your second comment. The IMF is not recommended a change in the perimeter of the state. I want to be very clear. What we say that there may be no choice but to think about that is a very different type of message, you know. We are not saying you need to change the perimeter of the state. If the perimeter of the state, the social model in Europe has served the regions very well. What we are saying is that when I do the math and I accumulate everything, I see a huge residual and I don't know how to close it. So what we say is that this residual may have to be closed through more radical reforms and more complicated fiscal reform than just the traditional one that we have observed. So I think it's and already thinking about that ahead rather than later when these decisions have to be made, I think it's important. So in my teams, I encourage them to think a little bit about this large adjustment. Why were they successful sometimes? And going beyond what the IMF has focused on, which is medium-term adjustment. You know, at the IMF, we're also very, I mean, Hera knows that. She supervised the Fiscal Affairs Department. I've worked myself a lot in the expenditure policy division. When I worked in this division and we did technical assistance, we were very careful with the social contract. We would usually make recommendations within the agreed scope of public services. We'd rarely recommend stuff that are really outside the social contract or outside the social norms, you know. But I'm just wondering whether this is we're a bit reaching the limits in terms of, you know, saying this is, yeah, you cannot touch that. I think the work of the fiscal monitor is very interesting on efficiency. I mean, there is a lot of room for efficiency, but my concern is that you can exhaust all this room and still have large adjustment needs and residual adjustment needs. And this one will have to think not just on how to be efficient within a certain set of services, but you will need also to have to think about whether even the scope of the services is the right one or whether there is an adjustment is needed. Thinking some countries have free healthcare, for instance, is it something that is affordable? That's the question. So we don't believe that the state should be reformed. So we're not saying that. We are saying, what if, and by the way, only in 1/4 of the countries in our sample. So I mean, I think it's important to see that. But in 1/4, the one with very high adjustment needs, I have a hard time understanding how some countries may be able to close the gap. Just one on Martin's point. Yeah, these are very relevant points. And I think the way I would address it is purely statistical way. We look at the median adjustment. So this very extreme adjustment where maybe there was much more adjustment for very idiosyncratic reasons, including through market pressures. We don't really capture them because I looked at basically what is the median adjustment in the past 30, 40 years. It's interesting what you say about the 0.5. My benchmark at the IMF is 1% a year for 3-4 years. I mean, we also have perhaps a much larger country sample than just Europe. I remember the 10 commandments of fiscal adjustment by Blanchard of the 2010s when he said maybe a benchmark of 1% a year. And that's what we see actually in the data, but only for 3-4 years, basically. And then you have it's a complicated question, your question about the preferences. I think we all want this adjustment to be orderly and not triggered by a market response, you know, an adverse market response. What do the French want? I don't know, I'm French, I could respond with I think the French do not like pension reform, for clear, but you need also to think in terms of third best. So if the French were propose an alternative between an adverse market event and having to cut drastically some public services that they are very attached to versus a pension reform, maybe the reflection would be a little bit different. So I think it's important also to think not just about the first best, the second best, but what countries, what populations may see as important in a third best environment. And policymakers should also discuss this with their populations. And I think in France, we are not at all in the third best type of reflection. We are really much into either we do the first best or the second best, or there is nothing else. I'm not sure whether this is enough but that's the way I would see this discussion.
Thank you very much. I think that we get a lot of food for thought, a lot of discussion on sustainability, fiscal and price sustainability. Let me thank all of you for staying a little bit much longer than what was actually scheduled. Thank you very much. Thank you very much, and have a safe trip back.
Thank you.
Hello, everyone. For the third session, we reconvene at 11:50. Another 12-minute break.
Very much more policy.
It's really good, no?
I give you a bit the understanding of what we discuss internally at the IMF.
It's about the either the first and second best in the brand.
Yeah. I mean,
That's a huge problem.
yeah. Giovanni, I may leave before the end. I'm not so sure. So if I don't see you, thanks so much for everything. We may not now. We are going to say for the next one, but I'm not sure. ERA is a taxi at 1 p.m. So
Bien parler comme ça, quand vous êtes bien devant. Vert, ça veut dire que c'est bon.
Summary of the pages.
Yeah, I think so. I think we already
Yellow,
is on.
okay. Now he's on.
And the light in green. Okay, everyone hear you. So if you want like
I could have taken screenshots like here in a second, but effectively it's not
Yes.
Yeah, to understand.
Yes.
We can take places just a second. Tell Ernest to come in. No. Tell Ernest to come in. Sorry. Hello, everyone, and let me make a little pre-introduction to this session that is very close to my heart. Is a really research agenda that we developed under the leadership of Ramon and that we are very proud of. And so I'm very, very happy to have this in the context of this conference. But I would like also to take this moment to make some big thank you to the people that have been working and organizing this conference. I have to say, first and foremost, I don't see him here. He disappeared, but here is Ermal, that has been really the pushing factor, idea, brain behind the whole event, and also Ernest and Dragana from SUERF. I mean, working with SUERF is a real privilege. and I really hope that we can continue working together. And also a big thank you to this lady here and to Sylvia. Here she is, Sylvia, that has been really the pillar together with Ermal on the organization on the ESM side, and Maria, that is, she's covering all aspects in the organization. Indeed, thank you so much. I mean, this DSA conference, workshop, seminar is a recurrent event, and it happens every year. And we are starting to think about the question to deal with for next year. And we are very welcome if you have any ideas and suggestions. But I really hope to see you again with us to discuss about fiscal policy and debt sustainability issues next year. But let me give the word to Marion and to this panel. Thank you.
Thank you very much, Giovanni. So can you hear me well? Yes. So it's my pleasure to moderate the last panel of this conference, which actually nicely wraps up what we have discussing yesterday and this morning. So this morning, just to recall, we discussed the macro impact, in particular of defense spending. Then we discussed also the fiscal challenges which arise from the current situation. So as a logical next step, the question is how can countries deal with these fiscal challenges and insure themselves against shocks? So the topic, the title of the panel is Making Sovereign Debt Safe and Sustainable in the EU. I think we can all agree that in this challenging environment, this is a key objective. There are different proposals on how to achieve this. And today we'll be discussing the proposal of the Financial Stability Fund. We are lucky to have the main architects of the proposal here on our panel this morning, who will, each of them will delve into the various facets of the proposal. So let me briefly introduce them. First and foremost, we have Professor Marimon, who is Professor of Economics at the EUI and at the Barcelona School of Economics. He will present to us, let's say, the general philosophy of the fund, the design, and how it can help countries insure themselves. Second, we will hear from Adrian Wicht, who is a postdoctoral researcher in international economics at the University of Basel. He will focus more on the interaction of the Financial Stability Fund with sovereign debt markets. And also on the role of lender of last resort that this fund could play together with the ECB. So the interaction with the ECB and with sovereign debt markets. And third, we have also with us Luca Zavalloni, who is here a senior economist at the ESM, and who will explore the interplay between the Financial Stability Fund and fiscal rules, and in particular, how this fund can enforce compliance with the rules. I think that's a key aspect for the credibility of the proposal. So we will we'll discuss that. And finally, our discussant, Pedro Pérez, who is a professor of economics at the Católica Lisbon School of Business and Economics, who will discuss the three contributions all together. So the way we'll proceed is that each of the panelists will have 15 minutes. Feel free to ask if you have, let's say, technical questions for clarification. But then the more general discussion of the proposal, of the policy implications, we will keep for the end. So, Ramon, the floor is yours.
Whoops. So thank you. And yes, this is work that we have been doing for some time now with my co-authors. At 25 plus, the euro is young, in a Europe who is old, born with aims to hold to the old values of democracy and peace, and new ones of competitiveness and green, gone through crises of broken debts, through pandemics of broken health, having institutions help, but the to-do list was getting longer. Woken by war in the courtyard, by broken lives in the seaside, by news The rules of the global game have changed and no longer your game. Lost to find her place and onwards, while a pandemic of broken values spreads. Now, the time to be the enlightenment in the world. Now, the time to be in command and arm of arms and deeds. Now, the time to build anew a sense of institutional fatigue. Do you think she takes like a woman, she breaks like a little girl, he said? I don't know, I'm just an economist. What can be done? If you are in a global economy of an uncertain world, a proud sovereign country, possibly within the Union, who is risk-averse and impatient, who can only secure himself in a smooth consumption by saving and borrowing, they call it debt. From the international market, debt, safer and more patient, but you cannot commit to always pay. Well, we will say you are an incomplete market economy with defaultable debt. Poor man. The only good thing about you is that economists have written a lot about you. Why not having an institution, say, of the Union and call it the Financial Stability Fund, who can cook a better contract for you, call it a fund contract, that will look into your risk and nightmares, pains and strengths to cook the contract, and will share with you risk, making your debt safe and sustainable, your consumption smooth, your crisis bearable. Sure, you will say, with your cranky tone, yeah, with Eurobonds with different colors. I already heard that one. Not exactly. Based on the fund experts' analysis of your risk and nightmares, pains and strengths, they will offer you a fund contract, a long-term state-dependent contract. Long-term because you and them are for life. Like the euro with his ECB tower, not for short stints. State contingent because this is what your pains and strengths are about. A debt and insurance contract with our securities you fancy, and giving your risky technology, your labor, your consumption, your government expenditures, and your sovereign debt with maturity 1 minus delta and coupon cap. Your current, the current budget to get in new debt looks like that if you don't default. Instead, if you had the fund contract, and the fund takes it all, we call it exclusivity contract, it will look slightly different. Because now you're going to have a component of risk taken care, and this for shocks that you might have. And then it seems to look the same from the perspective of the debt, but it has these other components. An effect of that is instead of having positive spreads, you're going to have none or just negative spreads. I see you are getting impatient when you say, come on, just by playing with budgets, you get reserve spreads. Tell me, how do you do that? Well, my experts, we find a location that maximizes the joint welfare of your country and the fund, taking into account some constraints. That's important. They call this a constraint-efficient solution. What a name. Since we have some time, we'll tell you about 5 constraints. Let me just start by the first 2. First, since you are a sovereign, you can always break the contract. And there is no penalty in our case. However, then you are left in the IMD economy having defaulted. This becomes the enforcement constraint, call it the no default constraint, where the value, the future expected value of this contract, of your consumption and labor, and maybe effort, is always have to be above that would have been for you to break the contract. The second, as an official lender of a union, you cannot have expenses losses. So we call that, it can be called that sustainability analysis. So if you put on the left-hand side the future surpluses, okay, the production minus the consumption and expenditures, that has to be more than something. If it's something negative, it means that we are willing to have permanent transfers, but I will be stringent and put that to 0. So it means you can never have in your contract expected losses. In a union means there will be mutualization at all. So that's a fun contract. You solve this problem, infinite horizon problem, between some weights to the fund, to the borrower, the country, and the fund. Each one with its own level of impatience, which one with a starting what we call Pareto weights, subject to these constraints. What is going to be happening here, I said there are no punishments other than breaking, is that the stick and the carrot, we're just going to be changing the carrot, meaning the relative weights, Pareto weights is X, might be changing. So if none of the two binds, then you only have this eta, which means that since you are more impatient, your weight is going to be going down. But it might be that the borrower is binding, then it's going to go up. Or the other way around, it is the lender. So everything happens in this square. What it is, the transition between the weight today, the relative weight today, and next time. There is the 45-degree lines, which will be the same, but then there is another line that goes underneath, which is the impatience. If there was nothing else, you will be going down and down and down and down to immiseration. But you don't go to immiseration because before you stop, and then on the left is when the borrower constraint binds. You cannot go lower than that. But then you can have a good shock, and then you move up because your value side is higher. How do you do? Well, we're going to revalue your contract. And then you stay there, but maybe a bad shock comes, and then the lender, which is on the right-hand side, say, that's too much, I cannot lend you more. And you would just be moving around this steady state in gray. So that's what it is, that the fund transforms sovereign defaultable debt into state contingent safe asset. So everything becomes safe. The fund contract then was smooth consumption, that is the case. And I said, when it binds, it does these things. When it binds for the lender, which says, no more, I cannot offer you more debt, then we're going to have a negative spread. That's when it shows up. So then you're going to be very well protected in the case of an adverse shock, because those are rare events, but you have huge protection for that. So we go. We did first with other co-authors, paper down Ristad, and looking at the euro area during the crisis. And here is how the data, how the IMD economy looks like, and how the fund looks like. You see a higher level of debt absorption, capacity, but then in particular, consumption is very smooth. Countercyclical, the NT down, is extremely countercyclical policy, 0.93. So, and you don't have spreads, negative if anything. Huge welfare gains. Those are contingents from the states, and those are way above. But most of this comes because this capacity to have higher debt and to this risk sharing helps, and then absorb crisis. And then if you look at in normal times, you can see that output, of course, fluctuates. Here there are two shocks, one to the technology, the other the government expenditures. Output fluctuates. Consumption is more smooth. But in particular, If you look at the help you have as primary surpluses, the red is always the fund, is huge. That means that your level of debt below is much higher. And then we look at spreads, we see the positive spreads in the IMD economy. We cannot even see it. There are little blinks of a negative spread there. Of course, you will say, what about model hazard? Yes, we do you buy that. And then they will be disrupting the full resharing. But now you see, that's how the X will going to be changing. So that now we know, our experts know much more how to do that. And so we don't have time for this. Or you want to talk about conditionality. And yes, the experts here have a theory conditionality, direct work on that too. But we don't have time to do this today. So then you'll think, well, you don't like such fund which is such powerful and exclusive as assumption. I want the private sector in.
All right, so let me take over. Here, we're gonna relax this assumption. So far, what Ramon presented you in this backbone fund is that you have an exclusivity contract between the country and the fund. Now, if you look at what's out there, and we are here at the ESM, so usually official multilateral lenders only hold a fraction of the country's debt. So now let's relax this assumption of exclusivity and add an additional player in the game, which are private lenders. And in analyzing this, we're going to be interested in having a minimal intervention. So I mean, the fund should do only the minimum. The rest is the country and the private bond market. So now what we have is that the fund, the country, can go to two different types of lenders. We still have the fund providing debt, insurance, so in form of our securities. And on the other hand, you have now the private lenders, a continuum of competitive private lenders that provide debt. And we assume that they're not providing any insurance. The simple reason is that private lenders do not like to insure countries. What is important in the model we have now is that the fund is going to take the decision of the private lenders as given and vice versa. This enables us to have a more comprehensive debt sustainability analysis. So far, Ramon already presented you that in the simple framework that he presented before, we have a DSA. So here we still have this idea that the value of the debt is equal to the present discounted value of future surpluses. But now we can be a bit more detailed because we have the value of the debt in the fund and in the value of the debt in the private bond market. So what you have as the last equation is an updated version of the debt sustainability analysis that tells you that the present discounted value of future surpluses should cover what Ramon presented you, this prudence parameter that we set usually to 0, so there is no permanent transfer, plus now a new term, which is this BLT. And this BLT is the outstanding level of debt in the private bond market. So this addition is very important and is going to be the basis of this minimal intervention. So the minimal intervention here, and it's really an interaction that you have to consider between the fund and the private lenders, has two aspects. The first one is that the fund has to consider fundamental debt crisis and also, because now we have private lenders, self-fulfilling debt crisis. So let's start with fundamental debt crisis. Here, the minimal intervention is basically that the fund has to stand ready to absorb the debt in the private bond market. And in a very specific case where we have those negative spread. As Ramon explained you, this is a new feature of the fund. The fund creates this negative spread, but this has spillovers on the private bond market. This leads to a sudden lending stop. And therefore, the fund needs to intervene in that case. The other case is the more, I would say, traditional case that lenders have to form belief about the creditworthiness of the country, and they might coordinate on the country being actually in a state of default. And this we don't want. Now, with the intervention of the fund and the introduction of private lenders, what we end up is that the steady state is more
restricted. So the box that Ramon presented you before now is shrunk. You have the dotted line that represents more or less what he presented before, so a fund with an exclusivity constraint. And now the solid lines are represented the fund with the intervention on a private bond markets. So what can the fund do in the case of self-fulfilling debt crisis, and also this together with fundamental debt crisis? Well, the answer is that the fund has to have a proper leadership and communication skill with the market. Now, the first element is that, and that's important in the model, at the beginning of each period, the fund has to announce the amount of debt that is safe and sustainable in every future state. And that's the main important thing. Once this is done, the sovereign country can go to the private bond market, and after this, the fund intervenes. That's the standard timing of action that we are considering in this model. Now, what will happen if this debt auction that is made in point 2, so this auction on the private bond market, fails? Then obviously the fund need to cover what the private lenders did not cover. You need to absorb the gross financial needs. And here is what gets interesting. So this gross financial needs actually depends on the average maturity. So from the literature on self-fulfilling debt crisis, we know that the longer is the maturity, the lower is the probability of a self-fulfilling debt crisis, because the amount of debt that needs to be rolled over gets smaller. Now, on the other hand, you remember that we have this minimal intervention of the fund. Whenever negative spread kicks in, the fund needs to absorb what's in the private bond market. So by lengthening the maturity, you are lengthening the part of the debt that is not matured, and therefore that the fund eventually needs to absorb. So here there's a trade-off, and from this trade-off emerge an optimal maturity. So graphically, here, if you look on the x-axis, this delta maps the inverse of the average maturity. If you're at 0, what you have is on average a one-period debt. If you are at 1, on average, you have a perpetuity. So when you move from 0 to 1, you are lengthening your average maturity. Now you see that when we go from 0 to 1, the gross financial needs is decreasing. And this is the standard channel that we expect. But now we have this blue line that is increasing. This is the part of the debt that the fund may need to absorb. And therefore, the crossing of those two lines determines an optimal maturity. So this design that we have here implies an optimal maturity structure for the country. Despite this optimal maturity, the absorption of the fund, so what's the financial capacity of the fund and the need to absorb the debt, might be very, very large. And that is why we have here an additional player that has to enter the game, and this is the central bank. So this might be the most important slide from my side of the presentation. The problem that we have is that the fund may need to absorb an amount of debt, but may not have the financial capacity to absorb everything. So in other words, intervention is not credible. The solution is to make the central bank intervene. Now you have to be careful to make the central bank intervene, because the central bank should intervene on a bond market that is safe and sustainable. And this has been the fundamental of the ECB's intervention during the TPI and the OMT intervention. So here, this is where the complementarity of the central bank and the fund becomes very important. And in fact, we have a perfect complementarity, because on the one hand, the fund, through its intervention, ensures that the sovereign debt market is safe and sustainable, enabling that the central bank can intervene in this market since it's safe. And on the other hand, the central bank, through its absorption capacity, ensures that the fund's intervention is credible. So we have here the complementarity of the central bank and the fund that together form an effective lender of last resort. And we see already that in the ECB framework, this idea that the ECB intervened only in a safe market was here. Now, let's analyze the case of Italy with what we have. Well, we calibrate here the model from 1992 to 2019. Under this period, the average maturity was 6.2 years. Now, if you put this fund in the computer, the numbers that it actually gives you in terms of absorption is 105% of Italian GDP. So that's quite a high number. Now, if you calculate this optimal maturity that I showed you before, you can reduce this absorption to 90% of GDP. Again, Italian GDP. So this is still very high. So a fund alone might not be able to absorb this alone, and the intervention of the central bank is here necessary. The second element that I want to show you here is that we can calculate a counterfactual path for Italy. What would have been the debt to GDP ratio of Italy if it had joined this fund that we designed in 2000? So what we have here is a debt decomposition where the debt to GDP tomorrow is equal to debt to GDP today plus net holding cost, which is R minus G, plus primary deficit. So here you see on the left panel Italy with this decomposition. In blue is the value of the debt as it is, and then you can decompose and you see that what was driving the Italian debt up was really this R minus G. Here, Italy had a very low growth and a high interest rate on its debt. If you make the fund intervene, here we do a counterfactual analysis. So what we have is the same growth path. The fund does not impact this, but it impacts the interest rate. As Ramon said, the interest rate becomes safe, so you borrow at the risk-free rate. And what we end up finding is that in 2019, if Italy had joined the fund in 2000, debt to GDP ratio would have been 85% of GDP instead of 135%. So a 40 percentage point difference. And with this, I'm done, and I'm giving the lead to Luca and the fiscal role. Thank you very much.
Reason why there is a good argument for having debt in a certain range. Now, if you want to enforce debt on a certain range, maybe because you don't want to charge future generation with a lot of debt, then maybe you want to think that this fund should also account for some sort of fiscal rule, which kind of aligns incentives, and in particular, again, among generations, because something that we really don't want is that basically to float the next generation of debt, I think, by front-loading consumption. But this we'll see later on. Now, when we introduce a fiscal rule, we want to do it in a very simple way. So what we do, we put a rule in terms of primary surpluses. So my tau is the primary surplus, and this rule is a sum of two components. One is a debt-stabilizing primary surplus. Simply, in order to stabilize debt, you want to repay your interest. So your primary surplus should be enough to repay the interest. This is the first part. The second part is, well, you want the debt to convert to some level that I call V bar bar. Okay. So this rule is very simple, and this sum of the two components. It's not in terms of debt to GDP, it's in terms of absolute values, because I think this is a bit more consistent with the new EU fiscal framework, but those are details for now. So with this new fiscal rule, very simple, the first exercise that we want to do, well, okay, now let's go back to the incomplete market economy with default, how we model our economy in absence of the fund. And let's see if we put this fiscal rule and we put that maybe if we don't comply with the rules, there's a cost. And our cost is pretty high, the one we put. It's maybe 10 times what is in the European fiscal framework. Now we put a cost of 0.5% in terms of total factor productivity. Is of course you can smooth it out a little bit. In practice, in terms of GDP, is a bit less, but it's still substantial. Well, what we find in our economy is that compliance is still low. So our government government still want to deviate from the rule and borrow quite substantially. Indeed, now if we plot the total factor productivity shock, you see that this is kind of consistent with what we have in mind, is that in good state, when the shock is high, the area is white, meaning that you are complying with the rule, while when you have a negative shock, you are in the gray area and you're not complying with the rule. So this is kind of consistent here. I think our puzzle thing is that even though you put a relatively high cost, compliance is still 20%, which is not very high, and probably you see a little bit more compliance in practice. Okay. So now let's move forward and say, okay, now we want to put this very simple fiscal rule into the fund contract. Now, what is the problem here? Now, let's bring together these two rules. So the specificity of the fund is that you're not only providing debt, but you're also providing an insurance contract. So what you can always do, you can decompose the asset that the fund is providing, I call it omega, in two components. One is omega bar, which is the debt component, this is debt, and one is omega hat, which is the insurance component. Now, the insurance component can be high if you receive a transfer from the fund, or it can be negative if you actually pay the fund a transfer. Okay, this is a typical insurance, typical 𝘊𝘶 component of insurance. Now what happens is that if you think in terms of the first component, the debt stabilizing primary balance, now if you know that you're receiving a transfer from the fund, you need less primary balance to stabilize your debt. That's where the insurance kicks in. And that's what makes the rule now state contingent, and contingent on the fact that the fund is going to provide you this new asset. So there is a difference between these two rules, which is exactly the insurance component, which I call omega hat, and this insurance component is the one that provides cyclical stabilization. Now, another important aspect that we need to consider is that when the fund sets optimal policy, is also have to take into account that two notions of debt. One is the one which enter into the fiscal rule. Now, we have legacy debt. The debt today is a sum of past deficits. Now, but it also have to take into account a forward-looking measure of debt. It needs that future choices of debt needs to be consistent with the fact that with the primary surpluses. So in setting the optimal allocation, I need to consider that future primary surplus will need to be consistent at any time with our debt. And that's why if we do some transformation, we substitute this omega hat that we want to simplify, we do not end up with only one constraint, which is a fiscal rule, but we need to take into account of two constraints. Now, one is the fiscal rule, which is the first one, once we introduce this summation, but also a second constraint, which is basically the fact that the omega bar, the debt, should be consistent with the present discounted value of future primary surpluses. Is a, if you want, consistency constraint, but it turns out very important. It took us a while to figure out that we actually need both in order to characterize the fund contract. Now, we have multiplier associated to these two constraints that we call 𝑘𝑓 and 𝑘𝑝, 𝑘𝑓 being the one associated with the rule and 𝑘𝑝 the one associated with the second constraint. Now, if we consider this constraint, now we want to know how the box that Ramon showed will change once we account for the rule. And this will change substantially. Now, what Ramon showed you is that the dynamic of consumption can be characterized by what we call the relative Pareto weight, our X. Okay, think to X as consumption. Now, consumption tomorrow, X prime, is a function of X of consumption today, but this will decay at a rate eta, which is less than 1. So what Ramon showed you is that absent limited enforcement constraints, then this economy consumption will start very high, but then will decline and will lead to immiseration. What actually prevents is the fact that there are limited enforcement constraints, And in particular, what we see is the multiplier 𝑣𝐵, which is a multiplier associated with the borrower limit enforcement constraint, which actually makes consumption go up. But this is the only force which actually stops consumption to decline. Why I'm stressing this, which is a little bit technical, because this is the big difference with the fund with the fiscal rule. Now, once we introduce our machinery, this very simple law of motion for consumption changes. We have some additional terms. Now, the important terms is the multiplier associated with the fiscal rule and our consistency constraint, what we call 𝑣𝑃 minus 𝑣𝐹. Now, this is at the denominator, and this is typically negative. So this overrides the fact that the fund will make consumption decay, but indeed, because it's negative, it will make consumption go up, which is what you expect when you apply the rule. Now, if you have that 100% and then debt will gonna decline at 60%, then in an economy with less debt, of course, you pay less interest and consumption is gonna increase. Also, your economy is gonna be less distorted. So this force will actually change the dynamic of the fund, but there is something more, which is this strange object, which we call 1 plus 𝑣⁻●. And this is the fact that now the fund, sometimes it also wants to relax the rule. But how do you relax the rule if the rule is always in place? Now, a way to do this is actually to introduce a negative spread, because if you introduce a negative spread, it's like an haircut to the country, to make an additional transfer you want. By introducing a negative spread, and this time you have this negative spread in equilibrium, actually you are helping the country in some very specific state, which is when you have a very bad realization of the economy. So we have all these complex dynamics going on, and this makes actually the implementation of the fund with a fiscal rule very different from the one absent the fiscal rule. So just to explain what we have in mind in terms of implementation. So the idea is that the sovereign enter into a contract with the fund, and the fund says, okay, we provide you a contract, but in the contract you need to have full compliance with the rule. If you do not comply with the rules, there is a breach of the contract and you exit the contract from the fund. Okay? It's a strong sort of form of commitment on the side of the fund, which tells the country, well, you have to comply at any time. If you don't, you're out. But there are no penalty for compliance. Here's only the carrot, and the carrot is the fact that the fund can provide the state contingency. It can provide insurance to the country. Okay, so no penalty here. What is gonna happen, and I'm gonna show you in the simulation, is that while in a fund contract, because the borrower is impatient, consumption is very much front-loaded and decreases over time. In the contract with the rule, consumption is back-loaded. So it decreases, it starts low, and then it increases over time as your debt decreases, as you would expect. Now, let me go to a bit to the calibration. So I use a similar calibrations that we have in the paper calibrating on Italy, the one with multiple equilibria. And we see that the fund with the rule, of course, now I put 60% because it's what everyone has in mind from the rule. So you converge to a steady state level of debt to GDP to 60%, as opposed to 110 in our calibration, and roughly 150% that the debt that you can achieve with the Financial Stability Fund. But now, how does the property of the fund with the rule change? Well, you still provide quite a bit of stabilization. Now, if you think the volatility of consumption compared to the volatility of output is very low and much lower than in the data, even though it's higher in respect to the economy with the fund. And if you think to the correlation between consumption and output is even lower than the one you see in the Financial Stability Fund. Okay, so very countercyclical, if you want. Now, let's look at what this means in practice. Now, you follow a rule and you enforce the rule at any time. Now, for me, debt is the blue one. Let's focus on the left-hand side, where I have debt in absolute value. So the blue line is the trajectory of debt, and debt will decline up to the 60% debt target. Now, if we account for the sum of debt and the insurance component, which is the red line, we see that it's not as smooth any longer, but it goes up and down. And this is because the difference between the two lines is indeed the insurance component, which is active every time, at any time. So the insurance component is active and is significant in this economy. Okay, it's not tiny. Now, if you think in terms of debt to GDP, what you see is a similar picture, not so evident, but you see that there is basically this decoupling between the debt to GDP and, if you consider the sum of the debt, but also the insurance component. Now, let's see in comparison with our MD economy, where again, the shaded area is where you do not comply with the rule and the white area where you comply with the rule. Well, in the MD economy, the debt is much more volatile compared to our economy. And of course, it doesn't stabilize. It just stabilizes around 110% of GDP. And in the MD economy, you also have default. And now I'm not showing you, but if you prolong the simulation, you will see period where the economy will actually default. Well, of course, with the fund, you will never default. But here is the point, and the point why we wanted to look at the fund with the rule. Now, this is the dynamic of debt to GDP. Under the blue line, the fund with the rule, you convert to 60%. The dashed line, the MD economy, and the red one, which is the unconstrained financial stability fund. Okay. Now, in this economy, because the government is very impatient, what it happens that if you enter the contract with 100% debt to GDP, what the sovereign will ultimately do, it will use all its fiscal space up to reach a very high level of debt, which is our 150% of the GDP steady state. What does it mean? It means that, yes, the contract is very good for the government, for the incumbent government. Indeed, the consumption on the right-hand side, you see, is very, very high. And this is very good from a present point of view. While if you consider the fund with the fiscal rule, the initial consumption is actually austerity. You consume less than in otherwise incomplete market economy, where you do not enforce the rule, or where the rule has some penalty. However, over time, what you see is that consumption under the fiscal rule, it increases and it goes above what it will be consumption just with the financial stability fund, which allows the country to ramp up the debt at the beginning. While in the economy, consumption is much more volatile. Indeed, you do not get this type of stabilization. Now, this is why we believe that is important for this kind of intergenerational linkages, because maybe it's not what we want. Even if in practice we can lead to very high level of debt and we have the fiscal space, we need to use it wisely. And that's why to have a rule, it makes sense also in an economy where you provide a full stabilization, as in our case. Let me finish with some welfare comparison, where I compare the incomplete market economy, the unconstrained fund, and the fund again. So this is welfare. Now, if you think to welfare, and think at the beginning, because this is what, when you propose a contract to a country, what the government is going to see is going, oh, what is the present value of the utility price today? So at time zero. Now you see that there is no argument. The unconstrained financial stability fund provides way higher welfare compared both to the fund with the fiscal rule and the economy. However, over time, having very high level of debt will distort your economy. We have distortionary taxation here, and the level of welfare will decrease below that would be a fund with the fiscal rule, and in some instances also below the IMD economy. Okay. That's why we believe that is very important with the rule, but also here the point is whether the contract with the fiscal rule is enforceable ex ante. Because now it becomes a bit tricky. You see that the beginning, the distance between the fund with the fiscal rule and the economy is not very, very big. And that be the point that what we see in our analysis is that you actually can enforce the contract. So the contract exists, but you have to be careful also about the target that you put in the fiscal rule. Now, if you put a target which is too low, if you force the country to go to 40% debt to GDP, it could be that from an ex-ante perspective, you may prefer to use a bit your fiscal space to ramp up your debt. And the insurance that they provide you is not enough to convince you to stay with the contract, while a more reasonable target, and we find actually that with 60%, you are a bit at the limit. You can actually enforce the contract. For that roughly above 60%, you can actually have this type of improvement. So let me wrap up. So we have a theory and also a toolbox to experiment the rules. And this also we can see how different targets and different type of rules can interact with the debt, with the fund, sorry. The fund contracts are self-enforcing. I think this is to me, the beauty of what the theories that Ramon has worked in over several years bring on the table. The fact that this is fully incentive compatible. So the fund is self-enforcing. You don't have need anything else. And now we see that we saw that the fiscal rule and the financial stability fund have very different dynamics, but we actually can merge the two. And to also from a policy perspective, we believe that is a good avenue to merge the two in order to align also our incentives. Yeah, so let me stop here. And as Ramon said, there is more to come. Thank you.
Very good. Very happy to be here. But I need my slides. I don't know where they are. Okay, they are here. Thank you. So what is this all about? This is about designing the EU institutions to get the most lending to member countries that is feasible and dealing with sovereign risk, self-fulfilling sovereign risk. So let's try to maximize access to lending to these member countries, and let's make sure that we are able to deal with self-fulfilling sovereign debt crisis. And we want to be thinking about the role of the ESM and the role of the institutions that are out there. So the role of the ESM, the role of the ECB. Now, I mean, the good news is that there's a lot of work that has been done recently. So I mean, I knew Ramon was busy. I didn't know Ramon was so busy. So this all goes back to, I mean, a really fundamental piece of work that has been there for quite a while. Recursive contracts finally came out in econometrically after being out there for, again, a long time. Marcet and Marimon's methodological paper. And building on this, I mean, the capacity to deal with these problems, then Ramon worked with a few co-authors, I mean, none of these here, on how to design what they call the Financial Stability Fund. That's in Restart. I mean, Ramon with Adrien and Luca, then they filled in the missing pieces in other work. So they added private lenders, they added a central bank. Now they are thinking about alternative ways of working with moral hazard, and there's still quite a few other papers. Now let me tell you a little bit about, and I don't have an incredible lot of time, so maybe I should speed up. So in that paper, so let me tell you a little bit about the Restart paper. So in that paper, they have debt sustainability, they have enforcement, again, enforcement problems, because again, the borrower can walk away, but they don't have moral hazard issues. I mean, in the presentation now that they went through. I mean, in the Restart paper, there was there was moral hazard. Moral hazard plays some role there. In any case, I mean, what's important in that paper is that you have this impatient agent that wants to borrow a lot to consume upfront and is exposed to shocks. So it's desirable that there's going to be insurance. Now, insurance is going to trigger moral hazard problems, and this impatience is going to trigger possible default. Now, I mean, they come up with the optimal contract, and I mean, the really, I think what's really interesting about that paper is that they come up with a measurement of welfare gains, and welfare gains are huge. I mean, Ramon made this point. They are about 10% in consumption equivalent. So going from a standard sovereign debt model, I mean, they take the standard model from, I mean, the state-of-the-art model from the shelf. They compute what's achievable there. They look at their optimal contract, and they get welfare gains that are, I mean, orders of magnitude above welfare gains that we typically get in optimal policy problems. Now, it's important to understand where it's coming from. So part of it is coming from risk sharing, better risk sharing. Another part is coming from this anticipated consumption, the fact that these borrowers want to consume upfront, and they're going to be accumulating debt. And because they have access to risk sharing, I mean, their debt is going to be safer, and they are able to accumulate a lot more debt. So we are going to have an economy with a lot more debt. I mean, when we compare the welfare gains that Lucas computed with the welfare gains that they get, it's because of this endogeneity of the shocks, because now they are going to have shocks that are endogenous and they could be a lot larger, but also because there's an impact on the level of debt. And it's, I mean, and welfare gains are a lot higher for those two reasons. Okay, they do a lot more again. I mean, we went through some of those papers. I mean, very important that they look at minimal intervention. There's one thing about this that I think it's potentially very interesting. I mean, the fact that the fund is out there absorbing the debt should have an impact on debt depletion, debt erosion incentives. I mean, that's a really interesting, more theoretical point. They add the ECB with more lending capacity. I'm going to talk a little bit more at the end about this. They have self-fulfilling crisis of the 𝘗𝘁 type. I think it would be nice if you guys took a look at the 𝘗𝑃 mechanism, because I think it can interact with the optimal mechanism, with the fund. Because the mechanism for the multiplicity is very different, and sustainability can be important for it. And then they come up with how the fund interacts with fiscal rules. I mean, the thing there that I have somewhat of a problem with is that, I mean, we have, I mean, you come up with an optimal contract in which fiscal rules are actually a very bad idea. And then you throw in fiscal rules, it would be a lot better to have the two together. I mean, to have a reason for a fiscal rule within the model. Okay, so 2 questions and a comment. So is the agent, I mean, is the borrower a country or a government? I mean, this is important when we want to be thinking about the real world, because we want to be distinguished. I mean, we want to be thinking whether we are talking about public debt or about total foreign debt. Now, there's no distinction in the model. In the data, there's not much of a distinction because private debt is very much tied to public debt. But when we think about governments and countries, there's an important distinction, is that I would say pretty much all governments are impatient in the sense that we see them building up a lot of debt, but it's certainly not the case that all countries are impatient, because in order for a country to borrow, there must be a country that lends. I mean, they basically solve the problem, for a borrower, but on the other side, there's going to be a lender. So if they solve it for Italy, on the other side, there's going to be Germany. So how does this affect Germany? I mean, that's another, I think, possible extension of their work. I mean, another thing is we want to be thinking of is, why isn't the market providing insurance? I mean, this insurance, the optimal insurance. I mean, their answer is markets don't like to insure governments. I mean, and that's a fact. I mean, you don't see it. I mean, you don't see market instruments anywhere close to the optimal prediction of the model. But maybe there's a reason for that, and that same reason, I mean, that's not just not liking, and that reason maybe applies also to policy. I mean, it's possible that the same reason why the market cannot do it, policy can also not do it. Now, when you think about it, there's some important difference between a fund and markets. I mean, one difference is size. The fund is potentially a lot bigger than individual lenders, banks, or I mean, there's another difference. It's horizon. I mean, the fund is possibly going to be there for much longer time and can commit. It's very important that the fund commits. I mean, it's not obvious how banks could commit to these kinds of transfer schemes. There's another issue that I think is very important. It's implementation. How do you settle this agreement about states? I mean, one reason to have that as an optimal contract is costly state verification. Maybe the fund can override some of the informational frictions there. I mean, the important point, and that's why I stressed the welfare gains, is that welfare gains are just too large to leave them on the table. So we really want to give a chance to this fund. Now, another issue, I mean, over time. So again, multiplicity. I mean, we know there's multiplicity. They look at 𝘗𝘁 It would be nice if they also looked at 𝘗𝑏. It's going to be hard. I mean, it's not an easy job to do that too. But we'd like to understand if there's an interaction between the fund and the 𝘗𝑏 source of multiplicity. I mean, they show that there is a very interesting interaction between the fund and the 𝘗𝘁 multiplicity in their optimal maturity stuff. So what's the role of the fund? What's the role of the ECB here? I mean, here, I mean, very briefly, I want to go back to an old idea on what's different between, what's specific about a country that issues debt in its own currency. What's the role of the central bank there? And I go back to this very nice paper of Corsetti and Daedalus that takes up on this. So, I mean, the European Union countries, they issue debt in their own currency. And with that, there can be outright default. But with currency, we never see outright default in currency. I mean, countries never default outright. I mean, they default through inflation, but they don't just stop. Just issue another currency. Sometimes they do when they have very high inflation. Then they take some zeros out. But that's in very exceptional circumstances. Typically, there's no outright default in money. What this means is that you can swap the two liabilities and avoid outright default. So just the threat of this stops runs. I mean, and this is a privilege of the United States, of the UK, countries that issue in their own currency, and they have a sovereign central bank. I mean, the thing with the European Union, is that we have indeed the countries issuing debt in euros, but they don't have access to the printing press, and they'd like to do that. So there's going to be a tension between countries and ECB, and we saw this unravel during the sovereign debt crisis. I mean, fortunately, it unraveled positively. I mean, maybe having an Italian leading the ECB made a difference there. Now, if the ECB does not take up this role, then there's going to be a role for a fund. We'll have to have capacity to address self-fulfilling crises if they were to occur. But then more important and more relevant what they are doing, the fund can make, ideally, could make the self-fulfilling crisis less likely to occur. Thank you.
Thank you very much, both for the presentation and then for the discussion. Before we open the floor for further questions, I would have also a few questions myself, actually coming more from a policy perspective. So first, we have well understood, I think, from your presentation that the success of the fund would hinge on having like an independent technical analysis, both as regards the fiscal rules, but also the DSA, because you would calculate ex ante how much debt would be safe. So have you considered in your reflections also the political economy considerations, because you say that it's a self-enforced contract, but we know in the real world that enforcement of fiscal rules is far from an easy task, is politically difficult. So of course, this is a theoretical proposal model, but I would be curious to hear how you have thought about this dimension, both for the DSA and for the fiscal rules, because this is really key for the credibility of the proposal. The second point, and I think Pedro was also asking about it, is how you would, let's say, embed this proposal in the current landscape that we have at the moment. What could be, so this could be, let's say, a sort of a game, like final proposal, but what could be intermediate steps to get to that objective in the current context and the role of the ESM in this regard. And the third point I was thinking about is whether this proposal would only fit within a currency union, or also potentially, you know, context where the non-euro area member states could also be part of that scheme, which would then create also coordination issues, because then we would have more than one central bank, so more lenders of last resort. But I think that's an important question to consider as well. So maybe I could give you some time to respond to, or like provide some comments after Pedro's presentation and my questions, and then we can open the floor for questions.
So, no, thanks. I think yeah. No, thanks for the discussion. It's really excellent. And in particular, yes, I think it's very good that we think more about the relation with the central bank with the Calvo lenses, okay, because that gives much more space that we have. And so I think that's very important. Let me just answer a little your question, not all, my colleagues. The fact that it's self-enforcing makes a huge difference. So, and the fact that we have the starting point, and that makes sense being in a union. We are here forever. So there is no need. I mean, that's how we do it when we do the ECB and monetary policy, but somehow in fiscal policy, no, we just look very short horizons. And that's a really bad way to do things, okay? So a lot, it builds up confidence because you do it this way. This means that, yes, if you think of an institution, it needs to be independent. Yeah, because you don't want to have all these discussions. I mean, but it also says that quite a lot can be done now, even. And it's true, people say, well, what about the state contingency? And we say it's important, it helps. But this could be done here. I mean, you just have the Greek debt in your balance and all these things. Spanish debt. Spain should be paying more than normal now that it's growing more than normal. Instead, Spain is growing the debt, and they say, oh, wow, it's fine because it's not so costly now. But the first paper in the morning tells us that we should be very careful. So there is an element which is so surprising here, is that not only we have high levels of debt, high levels of debt in the euro area, which is inside euro area institutions, here and the ECB, but we don't have a clear debt policy together. It's true, the ECB has the rules, we have the rules here, but it's not just the debt policy together. It is that in practice, in the debt market, you have a leading role that you don't take advantage of. And that's what